European equity markets then opening. We've got the earnings season really running pretty, well, we're in the heart of it, aren't we, here in Europe? We've got US earnings coming through, European earnings part of the story, and we seem to be right in the heart of it, and it does seem to be something that is firmly on investors' radars right now. We're also, of course, tracking the global story, in particular the emerging market story with a focus on India and Brazil around the virus and the spread of the virus, and we'll certainly get some analysis on that shortly. We'll be back with that story for you. So European equity markets opening up this hour, and up is the word, up by 0.4%. The FTSE 100 up by 0.1%. The CAC 40 up by 0.3%. We'll wait for the DAX to join the party. This after a rally in the US continued through to the Asian session. Investors focusing on the outlook for earnings and optimism around economic recoveries in the developed world, despite a surge in global virus cases. Let's put some of these competing themes together then this morning. Monica Defend, Amundi Global Head of Research, joins us. Monica, good to speak to you. How do you weigh up global, perhaps emerging market concerns now with regards to the resurgence of the virus against the earnings story, which seems to be coming in pretty strongly here in Europe?
Thank you. Good morning. Well, you know, the success in the vaccine rollout and in the containment of the pandemic proved to be the key success factor globally speaking. If you think about China later on in the US. Having said that, as far as India is concerned, for example, we have a really strong growth expectation, with India being the second in the row after China in posting a GDP growth around 9%. So we hope they will deal with the pandemic containment and this new wave of contagion. But this is kind of sequencing is something that we should expect globally until herd immunity is raised.
Monica, I wonder what you make of the banking sector at the moment. We're showing the Credit Suisse share price on the screen at this point, down by 3.5% right now. I'm not sure it's possible to draw a line between the Credit Suisse story, the idiosyncratic narrative that we have around Credit Suisse and the issues that they've faced recently, and the broader financial services sector. But what do you think of the banking space at this point?
Well, I tend to read the Credit Suisse as an idiosyncratic story. If you look at the reporting season in the US with JP Morgan, Wells Fargo, the numbers have been astonishing good, not on the revenue side, but more on the lower provision for loan losses. And this is something that is going to repeat itself in the second quarter. Similar direction, despite lower numbers in the European financial sector. You know, financials is a value call. So as long as we'll see a moderate increase in interest rates, which is healthy for the financial market, it will be particularly healthy for the financial sector and the banking sector in particular.
And Monica, with financials in mind, where do you sit on that rotation into value? One of the questions that we've been asking today on the Markets Live blog is what happens if both of the drivers of stock market performance disappear? So we're worried about tech because of reopening, but we're also worried about the pivot into value because of sustained virus infections. Where do you stand on that pivot from growth to value?
Well, usually, statistically, the value rotation lasts 24 months, so 2 years. And we do believe the rotation started in November as the vaccine progresses were announced. We're just in the middle, maybe, so we do believe the value rotation will continue. Recovery is in place, growth is nicely moving upward with a little bit of inflation. And this is really a nice environment for value to continue to perform, with central banks remaining accommodative.
Monica, thanks very much. Stay with us. Monica Defender, Mundi Global Head of Research, stays with us on the programme. We'll certainly be back to her shortly. We have to talk about what's going on at the ECB. We began this hour, though, talking about the competing themes in the market, one of them around earnings and the other around coronavirus. And let's get an update on one of the humanitarian stories there. We'll get an update from a country that's currently being hit hard by coronavirus. India reported the biggest one-day gain in cases seen in any country since the beginning of the pandemic, with almost 315,000 new infections in one day. We're joined now by our Mumbai Bureau Chief, Jeanette Rodriguez. Jeanette, give us an update. Bring us up to speed with the latest on the ground. What is the situation right now?
Thanks for having me, Anna. Well, as you said, India is now the fastest growing epidemic in the world. The pandemic is really slamming the country. The second wave has blindsided policymakers. The rate of infection spread is much higher than expected, and also it's proving to be more deadly, more lethal than the first wave. The concern now is how can we, the hospital systems are already overwhelmed. The concern is how can we keep debt low. On the financial and economic side, the concern is that if market sentiment sours, India's stock market will get into a technical correction. Economists are already downgrading growth forecasts. And there is concern among some analysts, including Bloomberg Intelligence, that if India's growth falls, its debt to GDP ratio rises consequently, and therefore sovereign rating agencies might actually push the country into speculative grade. That's the biggest risk.
That's the biggest financial risk. I understand, though, Jeanette, that social media posts are full up with people talking about the more immediate health crisis.
The humanitarian crisis is unimaginable, Anna. Social media pleas for oxygen, for hospital beds, for really attention for basic life-saving drugs is absolutely heart-wrenching. If you go into WhatsApp groups, which were previously dominated by bankers and traders, today they're asking for remdesivir, they're asking for oxygen cylinders. That is really a completely unprecedented state of affairs in India, where most of the so-called privileged sectors could have afforded care, but the hospitals are so overwhelmed that really it's anyone's guess who can get care when they need it.
Jeanette, thank you so much. Thanks for bringing us an update. Bloomberg's Mumbai Bureau Chief, Jeanette Rodriguez, thank you. Coming up on the programme, we'll get back to the business of central banking and, in a sense, the ongoing fight against the pandemic. It is ECB decision day. We'll be watching out for the economic outlook and messaging on exiting crisis measures. That is part of the conversation next. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest in China. But also, we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Welcome back to the European Market Open. We are just coming up to 10 minutes into our trading session here on European equity markets, and we have substantial moves in Credit Suisse. I see it's down 4.5% or so right now. Danny Berger joins us with a look at the movers, and she's picked Credit Suisse, of course, to feature in there after this capital raise and the ongoing crises and questions over risk management at the business.
Yeah, Credit Suisse especially stands out on a day like today, Anna, when we do have so many positive earnings news that's really beating expectations. And look, Credit Suisse did beat expectations. Their net loss for the first quarter was less than expected, but it's really that capital raise which is going to have investors concerned today, because in raising that sum, according to JP Morgan, this is going to dilute EPS by 7%. Citi says it's going to dilute EPS by 8%. So that's a pretty big hit if you're currently a Credit Suisse shareholder, not to mention the incoming charges they see due to hedge funds in the second quarter. Moving on to the more positive stories, though, Nestlé, a blowout quarter. This is really what I'm talking about when I say a lot of positive earnings stories today. Sales were twice as much as expected by analysts, really aided by the growing coffee consumption, especially in China. So those Nespresso sales really aiding earnings here. Volvo, the truck manufacturing, one of the biggest gainers today. This is a good story for the economy as a whole if more people are ordering trucks and construction type materials, so vehicles rather. So those shares up more than 4.5%. Volvo now seeing its biggest gain since January, with truck orders doubling what they were the quarter prior. However, Volvo also warning that semiconductor shortage is going to be an issue for them, and they might have to have days where they stop work on cars because of that shortage. But that today not impacting the share price, Anna.
Danny, thanks very much. Danny Berger with a look at some of the stocks on the move, from coffee to trucks to banking. Now, let's get to the central banking agenda. It is ECB day today, and we're not anticipating any policy changes, but we will be watching out for the central bank's economic outlook and assessment of financing conditions in the EU. Several officials have voiced concern over the bloc's sluggishness in approving the recovery fund. That's as focus shifts to the ECB's exit from crisis measures, which is set to coincide later this year with a potential change to its inflation goal. Monica Defend, Amundi Global Head of Research, is still with us. I keep reading that we're going to increasingly be asking questions of the ECB about its exit, about a taper. Is that really the case, Monica, when we think about, Europe is still gripped by the pandemic. We have extensive lockdown measures of various varieties in place in many parts of Europe?
In fact, I don't think this is the story now. It won't be the story for 2021. Likely, it will be something we will need to address, and maybe markets will start in pricing in 2022. Remember that the PEPP is really linked to the emergency. So as long as the emergency fades, then the ECB will need to engineer how to maintain easy financial condition. So this how will be the tricky point, when we will need to switch from the PPP to something else.
I wonder what you think will be said about sovereign debt yields at the ECB meeting today, and how much of a feature that will be. Last time we heard from them, of course, we were dealing with a spike up in Treasury yields that was spreading across the Atlantic, and the conversation was getting more difficult in Europe as a result. Is that still the case? I mean, Treasury yields off highs, but bond yields still elevated. I can't believe I can say elevated when you're talking about a negative number, but they're still higher than they were.
Yes, indeed. I mean, this increase in rates is something that is natural, if you want, for the very depressed level into something higher, because the recovery is in place. Obviously, a treasury lift is threatening the financial conditions in Europe as well as in the emerging markets, for example, and central banks will remain quite active in order to limit these spillovers. When it goes to the treasury, we have in mind 1.82% as a target, and we think that the ECB can easily front that.
Let me ask you about how you position in Europe with all of this in mind then, Monica. I see from your notes you're long Eurozone peripherals versus short the core. What's driving that positioning?
Well, there is this Draghi effect that is benefiting highly Italy, if you look at the spreads level. Now the market is looking to the structural reforms that the government is going to put in place, but definitely it's a Goldilocks moment on the yields, in particular on the long end of the curve when it goes to Italy. More generally, when we look at Europe on the equity side, we think that the reporting season will get some steam in the second part of the year. And as long as the vaccine rollout campaign will be faster and more capillary, this will support the recovery momentum. And this is when the value play will continue and Europe will outperform.
Thanks very much, Monica. Good to speak to you. Monica Defend, Amundi Global Head of Research. Monica will be continuing her conversation with us on Bloomberg Radio at 9 a.m. UK time. As I was just talking to Monica there, we were keeping you up to date with what was going on at Credit Suisse, showing you the share price under pressure, and we do see that in today's session, down 3.5% or so. We got those numbers through from the business, but the lender's warning it'll take a massive hit in the second quarter from the Archegos saga. We hear from our conversation, Francine spoke to him earlier on, Thomas Gottstein, the CEO of Credit Suisse. More from that next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Welcome back to the European Market Open here on Bloomberg TV. 19 minutes into a trading session that shows positivity across European equity markets. In particular, you see there on the CAC 40 up by 0.6%. Technology stocks doing pretty well. Banks under pressure today. It's been a horrible year for Credit Suisse, which has been rocked by one scandal after another, and the pain isn't likely to end anytime soon. Credit Suisse first quarter results this morning may have been better than expected, with a net loss of 252 million Swiss francs, but it says losses of 600 million from Archegos won't be seen until the second quarter. The Swiss regulator FINMA has also opened a probe into Credit Suisse over Archegos and over Greensill. We spoke to the CEO, Thomas Gottstein, earlier about the Archegos collapse.
We have addressed most of the issues now. Archegos, we are down to the last 3%. We have exited the positions to a large extent. And we have raised almost $2 billion with a mandatory convertible this morning. We have taken action in our risk organizations. We have taken management changes. So we have done quite a lot. Still some work to do in the second and third quarter, but we have taken a lot of measures.
So why did you arrive to the decision of doing a convertible bond instead of doing something else, or just raising capital outright?
Well, we have conditional capital. That's the best way for us to raise the equity. It's a short 6-month maturity. It was important for us to basically get to a 13% CET1 ratio, which on a pro forma basis we now have. And that was important for us to take the capital discussion off the table.
So what concrete measures are you actually taking to reduce risk, especially in the prime brokerage business, beside tightening financing conditions?
We are going through the entire portfolio. We have already started to reduce the risk. Our plan is to reduce leverage exposure by 35 billion by the end of the second quarter in this business. And we will take further action in terms of control systems, both on the first line of defense as well as in the second line of defense.
Before Archegos, you also warned of a possible financial hit from Greensill. What's your best estimate on that?
Greensill, we are working through with the administrator of Greensill Capital. We have brought back 5.4 billion in terms of cash out of the original 10 billion. We have good visibility for a large portion of the remaining positions. There are 3 more distinct positions which we'll work through over the next few months and quarters. We are not planning to do any form of step in. We are very clearly focused on getting the cash back to our investors. That's our priority.
Mm-hmm. So what is the status overall of the 2 reviews? And because of these 2 incidents, do you see any further personnel changes?
No, we don't foresee any other personnel changes at this point in time, but we obviously are doing an investigation. The board is doing the investigation, and we will inform about that outcome when we are ready to do so.
As the Credit Suisse CEO Thomas Gottstein speaking to Francine Lacroix. We'll bring you more from that interview throughout the day here on Bloomberg TV. A lot of important lines coming through from that conversation with regards to rebuilding capital and taking capital raising off the table. Some of the analyst commentary suggesting they may have been successful in that. That is going to be dilutive, though, as Danny was telling us earlier, and as we hear from some of the analysts this morning. Some lines coming through from the analyst call then today. The CFO over at Credit Suisse saying or confirming they are going to reduce the prime brokerage leverage by a third. The prime brokerage revenues will fall, and they are essentially going to see a smaller prime brokerage business. This all to do with their relationship between the bank and these big hedge funds, and that's where the Archegos story started, of course. Now, while shareholders digest the Credit Suisse earnings results, more details are emerging about the culture of risk-taking. Sources told Bloomberg that the head of prime services risk had previously been Credit Suisse's point salesman to Archegos. Joining us now is Danny Berger with a look at Credit Suisse specifically and where this culture of risk conversation moves next. Does this all speak then to an issue around risk management at Credit Suisse? I was reading our coverage this morning, Danny, and there's a suggestion that yes, it does happen sometimes. You get people move from sales to become the police person, a policewoman, policeman, essentially, but it doesn't happen all the time, and it certainly raised a few eyebrows.
Yeah, it definitely is rare, and I think in this circumstance in particular, it raises eyebrows because this is someone who had sold swaps, or at least been on the swap desk dealing with Archegos, and that's exactly the instruments that ended up blowing up, having those margin calls that Archegos could not meet. So that in itself is troublesome, but you have to look at the picture as a whole as well. Thomas Gottstein saying that this is idiosyncratic. However, questions are going to start emerging whether risk as a whole is an issue for them. The FT has a really excellent story out overnight talking about what happened to the risk management department when Laura Warner took over. A former equity trader herself basically did not want the division to look like an ivory tower of academics that dismiss certain deals outright. She wanted it to be a career destination. So that sort of attitude is one that potentially could lead to excessive risk-taking and could give Credit Suisse the kind of culture that puts them in the scenario that they're in now with not just Archegos, of course, but Greensill. And look, they had issues back in 2018, losing a lot of money on Canada Goose bonds. So this isn't new. This is a pattern that has been seen at Credit Suisse, perhaps down to a culture that now needs to change.
Yeah, interesting. You mentioned Laura Warner. She's the outgoing, of course, or she's left the business, head of risk and compliance. And our coverage also says that she challenged managers in her division to stop thinking about defending the bank's capital and to also look at strategic business priorities. So you wonder what this review, Thomas Gottstein referred to it, what this review will uncover about the way that risk is managed and if there needs to be any change in the culture there, or if there needs to be any reduced exposure to prime brokerage.
Good morning, traders. As you can see, I just showed you the position we hold on British pound, and I put stop on profit at 107,950 for all three positions. As you can see, we hold three positions. We was holding for about a week, and then it moved up price, and we try to hedge all one position. So right now we're in profit, and I placed stop on profit at 107,950. So if you hold these positions with us, if you did exactly what we done, you need to place stop on profit, and we will see if it will move lower. The price moved lower because it's short position. We will change stop on profit to, in our advantage, to lower position. Okay, at this moment, stop on profit at 107,950. Okay, I'll speak to you later. Let's see how low the price will go. Stay safe, guys.
Focus is odor detection, and this is because no matter how you're bound, what container you're in, you're still producing and releasing odors, and we're kind of building off of wildlife detection dogs.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the European Market Open. Half an hour into a European equity trading session that looks positive, up 0.5% on the Stoxx 600. Let's look at things from a sector perspective. Last time I checked, technology was to the upside, leading European equity markets a little bit higher. That continues to be the case. That sector doing well this morning. We spoke to the boss of SAP a little bit earlier on. That stock up by 1.8%. They pre-announced their numbers, but the technology space getting another day of positivity. We saw that to some extent at this time yesterday. Banks not doing so well. They're kind of towards the bottom of the table. We see insurance, though, and personal consumer, drugs and grocery stores, all of those sectors moving to the downside today. Let's get a Bloomberg First Word News update. Here's Laura Wright.
Thanks, Anna. President Joe Biden is poised to become the first U.S. leader in 40 years to recognize the Armenian genocide. Sources tell us the announcement will likely coincide with the massacre's Remembrance Day on Saturday. The move risks upsetting Turkey, which doesn't recognize the genocide, with Ankara's foreign minister saying if the U.S. wants to worsen ties, the decision is theirs. U.S. regulators are considering tougher rules for investment firms in response to the implosion of Archegos and the volatility around GameStop. Sources tell us the Securities and Exchange Commission is looking at how to increase transparency and disclosures. It's focusing on the types of derivative bets that sank Archegos. Russian police have arrested nearly 1,500 protesters throughout the country. That's amid demonstrations demanding the release of Kremlin critic Alexei Navalny. His health is said to be in severe decline after a 3-week hunger strike. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Laura, thanks very much. Laura Wright here in London. Now, it is Earth Day, and President Biden is hosting a virtual climate summit as he looks to invigorate the fight against global warming. The heads of state of all 40 nations invited are attending, including China's Xi Jinping and Russia's Vladimir Putin. And it's not just governments that are upping their climate ambitions. Former Bank of England Chief Mark Carney and Christiana Figueres, the architect behind the 2015 Paris Agreement, say the financial sector has an even bigger part to play.
I have never seen the financial sector move as quickly and as dramatically as we have seen them move in the past 2 years. And they do so not because they want to, quote unquote, save the planet. They do so because they want to protect their assets, the value of their assets. And they understand that continuing to invest in high carbon assets is actually investing in stranded assets and will decrease very quickly the value of their assets.
This is a critical year for action. There's tremendous momentum now. We need to reinforce that momentum. And again, having 70 trillion of private capital coming behind net zero, which is what's being announced today, is the type of momentum the world needs.
So that's what governments and the financial world are doing in the fight against climate change. But what about big business? My next guest was the Unilever CEO for a decade as it focused on separating growth from a harmful environmental footprint. Joining us now is Paul Polman, currently Vice Chair of the United Nations Global Compact and founder of Imagine, a foundation which helps businesses reach their sustainability goals. Paul, very nice to speak to you on this Earth Day. Earth Day, a good time to step back and see where we are in the fight against climate change. How would you characterize the point we've reached right now? It does seem as if the US and China politically are at some kind of inflection point.
Yes, first of all, happy Earth Day, obviously, but there is real momentum. On the one side, there is a job to be done. No country has really moved significantly since the Paris Agreement 5 years ago. We're still projecting to about 3 degrees at the end of this century. And more importantly, we need to cut emissions by 50% in the next 10 years, and few countries have made those commitments still. But there are signs of optimism, and the first one is really the conference that we now have in the US behind Earth Summit, led by President Biden and John Kerry. We've seen about 60 to 70% of the global economy already making commitments to be net zero by 2050. And we expect today and onwards, many countries also to make commitments by 2030. We've seen the UK making commitments for a 78% reduction by 2035. We've seen countries like Japan coming in, Korea, China by 2060. And we expect after the EU's 55% reduction commitment, we expect the US today to come in with a reduction of 45 to 50%. So there's real momentum at the government level, real momentum around policy changes. You heard Mark Carney talk about real momentum in the financial market, and not surprisingly, that is also reflected in the private sector.
Yes, and in the private sector, amongst the businesses you talk to, Paul, what is the thinking? Is the thinking that finally the politics has caught up with things that they've been thinking for a long time, or do businesses still, or do they feel as if this is going to be something that stands in their way? I have lots of conversations with businesses, with management, and the reference to the circular economy seems to have increased manyfold in recent years.
Oh, absolutely. Business understands this, and in some respects has been ahead of most of the governments over the last few years. We have about 25% of the businesses that have made net zero commitments for 2030, but that clearly isn't enough. And businesses can do about 60, 70% themselves. In fact, today already the technologies and the know-how is available to take care of the 60, 70% and actually do that profitably. But there are free riders in business, as usual, a little bit more shorter-term oriented, self-centered businesses. And there are also some bottlenecks that need to be changed. And this is where governments come in. So seeing now the combination of governments working together hand in hand with business is obviously the sweet spot you want to be. The reason business is moving is it's becoming increasingly attractive. Greening our economy is a job creator. Greening our economy is a financial incentive builder. We estimate about $12 trillion can be unlocked, and the smart companies are positioning themselves obviously for the future, not least helped by the pressure of the financial market. You just heard Mark talk about the Glasgow Alliance of $70 trillion of assets under management. And frankly, 90% of investors now see climate as one of the highest risks for their portfolios.
You say that, Paul, that this is going to be a green job creator. Tell me more about where the jobs come from, because an alternative analysis would be that you actually want energy to be cheaper to allow growth elsewhere. So you don't necessarily want to create jobs within energy production. You want to create jobs in other parts of the economy. How is it that the green revolution creates jobs? It might not feel like that if you work in the car sector, for example.
Well, if you work in some of the sectors that need to transform, like the fossil fuel or the combustion engine, if you want to, when you talk about the car, we need to be sure that we have a fair transition for these people. They've helped us, they've built their economies until today. But the reality is that greening our economy will create actually more jobs, more resilient jobs, and actually better jobs. You take already in the US, we see 6 times more job creation in the green energy sector. In fact, 60% of our energy that in the world is already cheaper being green energy than fossil. So I think we've passed that tipping point. We just need to accelerate it. And the jobs will come from restoration of our biodiversity, retrofitting buildings, the big investments that are now being unlocked on infrastructure, where we're moving to greener infrastructures, looking at our food and value chain and moving to regenerative agriculture, mobility, and electrifying our mobility systems. All these investments that are needed are actually only requiring about 1.5% more in spending, far less than the cost that we will be incurring, as COVID has shown. And they also actually are creating the better jobs that we desperately need.
Paul, thanks very much. Thanks for joining us. Paul Polman, the Imagine co-founder and former Unilever CEO, of course. Coming up here on the programme, we'll be back to the banking story, but a different take on where we are in the banking narrative right now, staving off banker burnout. We take a look at what Wall Street's doing to ease the workload on staff, or perhaps in some cases compensate them for it. That conversation next. This is Bloomberg.
model minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the US, we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy, and we need companies to step up.
Particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Welcome back to the European Market Open. 41 minutes into a European session that shows some movement to the upside for European stocks. Technology in particular to the upside. SAP, one of the stocks that's on the rise today. To the downside, though, Credit Suisse, share price in Credit Suisse a little bit weaker today as a result of the capital raise we've seen from the business, down by more than a little bit, down by 4.2%. The capital raise, part of that. Ongoing questions around risk, of course, also part of that narrative. The bank sector as a whole now in negative territory, down 0.4% on a day that is, broadly speaking, positive for European stocks. Now, sticking with the banking theme, the banker burnout conversation is still front and center for many. After complaints from junior bankers at Goldman Sachs made the rounds on social media earlier this year, JP Morgan is now the latest firm to take action. Danny Berger joins us with a look at some of the latest news lines, some of the latest detail. And Danny, what have we heard recently then from Wall Street?
Anna, there are a couple different models that various lenders are taking, and I should say it really is encouraging that we've heard from multiple banks. You'll recall this isn't a new conversation. The well-being of especially junior bankers has come up before, but could this actually be the start of real changes? JP Morgan's saying that they're going to hire 190 bankers to help deal with the workload that bankers are taking on and hopefully help to deal with burnout. So that's one type of action we're seeing, hiring more people, easing the workload. Another one, of course, is different perks, be it a fruit basket from Goldman Sachs or a Peloton from Jefferies. Now, the other way that we've seen some banks try to combat this is simply just pay bankers more. We heard from Bank of America a couple weeks ago who's doing this, a bonus for their bankers. According to Financial News, just reporting that UBS also looking at doing a similar financial compensation. But we should make this clear. It's not just about junior bankers. It's bankers as a whole and really everybody as they deal with the workload during the COVID-19 pandemic where people are working from home and working more frequently. With that in mind, a LinkedIn post went more or less viral of an HSBC IT regulatory worker who had a heart attack. And he says the first thing he thought of was, I need to meet with my manager tomorrow. This isn't convenient. That really caught fire, about 8 million people viewing it on LinkedIn. And HSBC responding here saying that the response to this topic shows how much this is on people's minds, and we are encouraging everyone to make their health and well-being a top priority. So, Anna, I think it's fair to say across the board, this is a conversation that probably needed to be had a long time ago, but now we're finally seeing responses from employers.
Yeah, and the HSBC employee that you referenced certainly suggesting this is broader than his business, sort of calling out the entire sector for the culture that exists, that does seem to, and this is anecdotal perhaps only, but does seem to have led many people to work those longer hours as as they've been working from home and find it more and more difficult to draw that line between the workplace and home life. Danny, thanks very much for ongoing coverage of that story. As Danny says, not new, but it keeps evolving. Now, Chinese antitrust regulators have put most of China's largest internet platforms on notice. Curb anti-competitive behavior or face a similar crackdown as Alibaba. As part of a new Bloomberg television special, Red Lines, China and Big Tech, our chief North Asia correspondent Stephen Engel takes a close look at how, up until now, China's so-called BAT companies, Baidu, Alibaba and Tencent, had flown under the regulatory radar.
I think companies like us, we invest more than 15% of our total revenue every year to do R&D. I think the government like that. And in the meanwhile, I think antitrust is also good for innovation. You just cannot imagine, the number one and number two guy all of a sudden merge and gaining more than 90% of market share in the US. But that happened quite a few times in China before. That's not good for innovation. So I think that the antitrust push is kind of justified.
One way the BAT biggies grew their girth was by pouring billions into many of China's next generation tech unicorns, sometimes even cross-investing in the same startups. It obviously further inflated the big platform's offerings, but arguments could be made on both sides whether the M&A closed off or cracked open competition.
When you zoom into one company and you say, well, gee, if the other guys are doing it and if I don't do it, then I am in a competitive disadvantage. So I think some measure to at least make the ground rule clearer, and that would certainly be helpful to us. Us meaning VCs who invest into early stage technology companies, quite frankly, with a goal of using new technologies and new business model to possibly disrupt some of these big companies.
More competition might be helpful to the perception of Alibaba, and that's growing. We see that with Pinduoduo, we see it with JD, we also see it with these streaming sites. That if you have all this traffic on the TikToks of China, including Douyin and Kuaishou, that you actually see a real opportunity for these companies eventually to make a dent in e-commerce. It's not there yet, it's happening, but there is competition on the margin for Alibaba.
It's important to note, many of these investments by Alibaba and Tencent flew under the domestic antitrust radar because nearly all the Chinese companies listed outside of China are done through a VIE structure, or variable interest entity.
For a really long time, antitrust authority did not vet any cases involving a VIE structure for fear of granting it legitimacy. Right. Because these had always operated in the legal gray area. Yeah. Okay? And as a result of that, you see, the duopoly that you just mentioned, Alibaba and Tencent have made hundreds of acquisitions without making any notification to the antitrust authority. The authority is sending a signal and make it very clear that VIE cases will no longer be exempted. They are going to scrutinize those deals. Although, some may say this might be a little bit too late.
Really interesting conversation there. You can watch more from Stephen Engel as he explores how far China will go in reining in its national tech champions. That program, Red Lines, China and Big Tech, only on Bloomberg TV. Coming up here, we're back to the markets. It is ECB decision day today. Investors are waiting to hear from President Christine Lagarde about how much longer the faster bond buying will continue. That could be part of the conversation, thinking about the ongoing use of the PEP program and where that takes us next. We discuss that with the Market Live team's Laura Cooper next. This is Bloomberg.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the European Market Open. 51 minutes, 52 let's call it, into our European equity session, and moves to the upside. Broadly speaking, the same cannot be said of the banking sector. We see the Credit Suisse share price under pressure today. It spent all of today's session in the red, off lows, but down still by 3.4%. There's a capital raise, of course, in there that we must mention. Let's get to the broader market picture, though. And joining us now is Laura Cooper, Bloomberg Markets Live macro strategist. Laura, good morning to you. Today is ECB day. A lot of the narrative yesterday when it comes to central banking was around the Bank of Canada. Some of the commentary I've been reading suggests that there will be questions put to the ECB about exit from extraordinary policy. I just wonder if it's too early for all of that, given that we're still in many parts of Europe in the heat of the pandemic.
And it is likely too early for them to hint at thinking about tapering yet at this stage. But I do think there's probably two key things that markets are going to want to look for from Lagarde today. One is on that significant increase in PEP purchases. That was where the attention was last meeting. And yet, if we look at what's come through on the data, it's not actually materially higher. So she will certainly be pressed on what is that extent of PEP purchases going forward. We aren't expecting to see any change in terms of that buying until the June meeting. That's when we will get those new economic forecasts. But then we're also likely to want some more clarity in terms of what we've seen more recently is just mixed messaging on that tapering outlook. Will it potentially be in Q3? Will it be March 2022? I think investors really want more clarity today. But it's a tricky balancing act for the ECB.
Yeah, and to what extent are these is it too early to answer these questions? Let me ask you about the various narratives that are pulling the market around at the moment, Laura. We're not far from all-time highs, of course. There's been some strong earnings news coming through from certain sectors. The banking sector a little bit different, it seems, here in Europe, today at least, with the Credit Suisse bias. So there's the earnings story on the one hand, then there's the virus story on the other, perhaps with a slightly more emerging market nature to it at this point. These competing narratives, then, how are they leaving the market between that push and pull?
Yeah, and that's really quite interesting, the fact that we are seeing these competing narratives, which makes it quite difficult to pin any kind of thesis to the kind of price action that we are seeing. But I would expect that this does set up for greater bouts of volatility going forward, because to this point, yes, we've seen cyclicals come under pressure, but it's largely been an upside trend on the back of this vaccine news. But we are seeing those cyclical valuations quite stretched. We are seeing, yes, it's still a high bar for the rest of the earnings season ahead. And the fact that we are seeing these virus risks come back. So yes, I would expect kind of more movements going forward, as opposed to the path of least resistance so far, which has really been to the upside.
Right, yeah, that's been the case. I wonder whether some of the things that have propelled us to the upside, though, could be in trouble. Let me get to the question of the day that you've been throwing around on the Markets Live blog, Laura. What is next if both sides of the pandemic trade fall apart? And this taps into what we were just talking about a little bit around the virus, but we seem to be concerned about both types of businesses, value and growth to some extent. We worry about growth because the pandemic will come to an end, and we saw that concern highlighted by Netflix. But then we also worry about value, don't we? And whether those kinds of businesses, with the pandemic resurgent in many emerging market economies, whether that is something that can be sustained, that performance. So where has this question taken us on the Markets Live blog?
Well, and I think it's quite an important question, because if we look, for example, just at European value, its outperformance over growth has been completely unwound since early March. It's year-to-date gain. So that certainly is kind of troublesome for that outlook. But I do think it's too soon to dismiss that value trade, to dismiss that cyclical trade, because if we look historically, the last time that Europe really outperformed its U.S. value peer was just after that post-GFC crisis, when we did see that strong economic recovery in those early stages. So I think the conditions really are still still there for that trade to take hold. And then in the U.S., given where we see U.S. Treasury yields around that 153 handle for the 10-year, it's quite low given in the backdrop where we're likely to see nominal GDP growth in double digits. So I would expect that overall that reflation trade can still have upside.
Laura, thanks so much. Laura Cooper, Bloomberg Markets Live macro strategist. Thanks for bringing us your thoughts today. Thanks for closing out this hour of the European Market Open. Surveillance Early Edition is up next. They'll continue to take you through this market action. European equity markets on the front foot as the sun shines over London. US futures fairly flat. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We have addressed most of the issues now. Archegos, we are down to the last 3%. We are going through the entire portfolio. We have already started to reduce the risk. We're in constant dialogue with regulators here in Switzerland, but also in other places. Archegos was a situation that is now being reviewed also by US regulators. It was a very idiosyncratic situation with a family office. We are all responsible for what happened. It's now our job to take Credit Suisse to the next level.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance, the Early Edition on this Thursday, well, the 21st of April. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Credit Suisse slides as Thomas Gottstein tells me the damage from Archegos will spill over to the second quarter. The Swiss lender raises $2 billion to shore up its finances. More from my interview with the chief executive shortly. The Swiss regulator begins enforcement proceedings against Credit Suisse after the blow-up. Gottstein tells the bank, or says, the bank is in constant dialogue with FINMA. And Bloomberg learns the SEC is considering tougher disclosure requirements for firms in response to the implosion of Archegos. Derivatives and short positions may be added to current filings. So it's definitely been a tough year for Credit Suisse, which has been rocked by one scandal after another, and the pain is not likely to end anytime soon. While Credit Suisse's first quarter results this morning may have been better than expected, with a net loss of 252 million Swiss francs. But it says additional losses of 600 million from Archegos won't be seen until the second quarter. Swiss regulator FINMA has also opened a probe into Credit Suisse over Archegos and Greensill. Well, earlier we spoke to the Credit Suisse chief executive, Thomas Gottstein, and I asked him whether the bank's problems were now over.
We have addressed most of the issues now. Archegos, we are down to the last 3%. We have exited the positions to a large extent. And we have raised almost $2 billion with a mandatory convertible this morning. We have taken action in our risk organizations. We have taken management changes. So we have done quite a lot. Still some work to do in the second and third quarter, but we have taken a lot of measures.
So why did you arrive to the decision of doing a convertible bond instead of doing something else or just raising capital outright?
Well, we had conditional capital. That's the best way for us to raise the equity. It's a short 6-month maturity. It was important for us to basically get to a 13% CET1 ratio, which on a pro forma basis we now have. And that was important for us to take the capital discussion off the table.
So what concrete measures are you actually taking to reduce risk, especially in the prime brokerage business, beside tightening financing conditions?
We are going through the entire portfolio. We have already started to reduce the risk. Our plan is to reduce leverage exposure by 35 billion by the end of the second quarter in this business. And we will take further action in terms of control systems, both on the first line of defense as well as in the second line of defense.
Before Archegos, you also warned of a possible financial hit from Greensill. What's your best estimate on that?
Greensill, we are working through with the administrator of Greensill Capital. We have brought back 5.4 billion in terms of cash out of the original 10 billion. We have good visibility for a large portion of the remaining positions. There are 3 more distinct positions which we'll work through over the next few months and quarters. We are not planning to do any form of step in. We are very clearly focused on getting the cash back to our investors. That's our priority.
Mm-hmm. So what is the status overall of the 2 reviews? And because of these 2 incidents, do you see any further personnel changes?
No, we don't foresee any other personnel changes at this point in time, but we obviously are doing an investigation. The board is doing the investigation, and we will inform about that outcome when we are ready to do so.
Are you looking at any risk parameters in other parts of the business outside prime brokerage?
Part of the investigation will also focus on the overall risk organization, the risk processes, the risk systems. We are also in the process under the leadership of the board and myself to look for a new risk officer. As you know, we have appointed Joe Oechslin as our interim chief risk officer, and we will then inform further once we are ready.
But do you think you'll have to tighten risk parameters and in other parts of the business?
Well, we had 2 incidents, one in asset management, one in prime services. We have had a very strong record of the last 10, 11 years in terms of credit provisions. If you look at our provision for credit losses, it has been a very strong track record over the last 11 years. So I don't think we have a DNA problem in terms of risk, but we will definitely review all our risk systems and processes as part of this exercise.
So after this exercise, how different do you think Credit Suisse will look?
Look, we have an incoming chairman from the 1st of May. We will, together with him, review our entire organization, and we will then also inform the public as we move into the second and third quarter.
So what will your priorities be when the new chairman starts? What are you looking at?
Well, the priority now is to really go back to running the business and to have, again, a stable situation. That's very important for us, and we are open for business. One of the reasons why we did the mandatory convertible was also to have the strength of the capital base, not only to withstand any possible shock, but also to grow the business. And it's important for us that, especially in Asia, in Switzerland, but also in IWM, we have the capital to further grow the business.
My conversation there earlier with the Credit Suisse Chief Executive, Thomas Gottstein. Now joining us to discuss all of this is Elisa Martinuzzi, our Bloomberg opinion columnist covering finance. Elisa, I would say two remarks. First of all, we can applaud Credit Suisse because actually the Chief Executive still went on camera and answered tough questions. But two, there were very little details. So why are they saying so little? Do they not know how they can de-risk, or are they waiting for the chairman to arrive to help with strategy, or is it simply because of the ongoing investigations?
Well, as you say, I mean, you did ask a lot of questions. The detail is thin. I think a couple of things, really. I mean, one, they have raised this capital, which should put investors at ease in the medium term, that the bank is sound and won't need a hasty cash call, which should be good. But I think the uncertainty relates to two things. One is they've only just really started what appears to be a pretty broad-based review of the risk-taking right across the firm. And, they were pressed hard on the analyst call. Does this risk review pertain just the investment bank and just, prime broking, or is it across the business? And it is right across all of the units. So that will take some time. And then secondly, as you say, there is, a new chairman coming in next month. And of course, it'll be up to the board with the chairman to review the strategy. What is, I guess, the main question now with regards to strategy is how large do they want the investment bank to be? They've already signaled they're going to be scaling back the prime broking business by about a third. And my rough calculation shows that they're basically paring back the investment bank by about a tenth. And this is the starting point. And the question then becomes, well, if you take less risk, how does that affect your revenue? And then, longer term, where does that leave the firm in terms of where it wants to be in investment banking? And does it want to put more weight behind wealth management, which at the moment accounts for about 2/3 of the overall business? And do they want to shrink that investment bank even further?
Elisa, can Thomas Gottstein actually survive this?
It's a valid question. The way they've put the capital raise across was that this is an initiative by the CEO, by the CFO. They've gone to the board. They've put to them the proposal to raise this capital, and this would signal they're trying to get ahead of the situation, and not be constantly behind the situation. But it does beg the question still: how was the prime broking business allowed to build such a massive position vis-a-vis this one particular business, Archegos, and how did that go unnoticed? And I think, as the company reviews the risk-taking, as the regulators probe, it'll be, he has been in the job for a year, so he will need to show, how that got out of hand under his oversight.
Elisa, thank you so much, as always. Elisa Martinuzzi, they're a Bloomberg opinion columnist covering finance, and one of my sounding boards, actually, for a lot of the conversations that I have with bankers. Elisa, always smart, smart, smart. Now, conversations on Bloomberg Surveillance Early Edition continue. It's Earth Day today. Later on in the program, we speak to the chief executive of Klarna about the fintech's sustainability plans. Before then, though, we also speak to the UK Business Secretary, Kwasi Kwarteng, about Britain's green ambitions. Up next, we speak to Jim O'Neill, Chatham House Chair and former Manchester United non-executive director. I know Jim will have a thing or two to say about this Super League. Send your questions or your thoughts on IB Plus TV Go. This is Bloomberg.
is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significant.
Okay, traders position closed on Japanese yen. As you can see, we was holding this position for a week probably. We didn't lose anything at all. I mean, even overnight, broker paid us quite a good amount of money to hold in overnight. So all three positions sold. So if you followed this trade, you made profit on it. I will calculate and I will post this on the screen, how much profit we made. Well done, traders. Let's look for another trading chance, trading opportunity. Okay, if you would like to get this strategy, you can get it from our website. You need to buy it. It's not free. You have to go to company.co.uk and you will get the strategy. We provide support for life. So if you will have any time questions, any day, you can send us information, you can contact us, and we'll be happy to help you with this. Also, we provide webinars and free 15-minute webinar as well. It's all information you can find on our stream channel or on our website. I'll speak to you later, guys. Stay safe.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua here in London. Now, European football club owners wanted a US-style competition, but the plan collapsed less than 2 days after it was floated. In the face of furious opposition from fans, players, politicians, and pundits, most of the would-be founding members pulled out. The anger from football supporters has forced the owners to issue an apology. Liverpool owner John Henry took sole responsibility and said, "In this endeavour, I've let you down." Manchester United co-chair Joel Glazel says he apologizes unreservedly for the unrest caused by the proposals. Well, Glazer's rare public statement comes after the club's chief executive, Ed Woodward, resigned over the plans. Well, our next guest is not only the current Chatham House chair and former UK government minister, but also, of course, he's a lifelong Manchester United fan who served as a non-executive director at the club before the Glazers' takeover. So Jim O'Neill joins us. Thank you so much, Jim, for joining us. I have a lot of questions on, money chasing assets, but actually I really wanted to get you on to talk about football. I mean, how was your week? Were you outraged by the proposal, or do you see, from a business sense, value for having the Super League?
I take it the second part of that question's a joke. It's got to be one of the most ridiculous proposals in nearly 40 years of business, and another 20 plus living in this world, is one of the most ridiculous proposals I've ever seen in my life. So,
but this would just make it more like the US.
Story, well, maybe, but first of all, it's not going to happen. Secondly, I don't really agree with that. You're from Europe. How can something be called a European Super League if it doesn't have any representation from the two biggest European countries? I mean, there are just so many things about it that are just so ridiculous. Amongst the millions of questions, you want to get Jamie on here from JP Morgan and ask, how on earth did such an experienced CEO that is so good at so many ways by the standards of the industry I came from on connecting with the real world, how on earth did they let themselves get this proposal to where it got? It is ridiculous and epitomizes so much that has become wrong about modern sport, and particular football. But luckily, you've seen a massive reaction. And maybe this is the beginning, the crescendo moments, and the beginning of what I would call a shift back to profit with some purpose, and actually linked to stuff, Francine, you and I have thought. Sorry, go on.
Yeah. So, do you think that actually fans, right, need to have a stronger say in some of these clubs? And what would you do about it? So, could you raise funds and actually do something with Manchester United?
The answer is yes. And as you know, linked to the second part of that question, for the as far back as 2010, I first got involved in efforts to try and help, let's call it a more fan-based or philanthropic approach to ownership of football clubs in England. And it looks to me reflective of the peculiar way this government has been shaped. There's a possibility that this might actually come into legislation. And I hope so, as well as the need for a proper independent regulator to put the Football League, the Premier League and the FA under much stronger scrutiny and to stop them being bullied by supposedly successful business people.
Are you telling me you're trying to take over Manchester United?
No, I'm telling you that policymakers appear to be putting in place what is necessary to allow a much more fruitful and societal supportive structure of football clubs and get us away from the nonsense that's been going on for the past decade or longer.
Okay, can you lift money, and then we have to talk about the market, but can you actually raise money and do something? Is that, or are you waiting for regulation, or do you want to, Jim O'Neill, get involved in running or having, being heard on the board of Man U?
I'd rather deal with the first part of your question. I believe there needs to be a new independent regulator for football, and we need to have fan-based ownership of football clubs, or serious ability of fan groups to stop particularly leveraged owners doing whatever they think will give them the right to extract even more cash out of those clubs. Enough is enough.
Jim, on the markets overall,
make of that what you want, Fran.
I know. I mean, if there's breaking news, you'll have to come and tell me first. If you look at the markets, be it SPACs, be it everything that we're seeing maybe with our Archegos and some of the financial calamities that we've seen, is it money chasing yields? And do you worry that this will end badly?
Listen, markets are markets, and as we've discussed, I don't know, 10 times over the years, greed and fear are very close cousins. And the more the markets go up, the more people dream up ways to supposedly sustain it until it gets to the point that there's no idiot left to create a SPAC, etc., etc., etc. In terms of the immediate future, whether that be weeks, part of me thinks we're coming up to May, and the conditions are almost perfect for a sort of sell in May and go away strategy, given the huge rise of the past 14 months, which actually has been pretty predictable and something I expected. But we now have a very strong recovery that's starting, led by the Anglo-Saxon world. I suspect continental Europe will join in soon as the vaccine rollout accelerates. But that's, on the one hand, very positive for economic growth and hopefully help unemployment from rising much. But it will probably make the market outlook more complicated, because central banks at some point might start to rethink whether they need to be as generous as they are. And so I think it's a fantastic environment for my old world of macro investing, as you can see with the performance of some of them. But it's going to get trickier for some of the outright equity long-based strategies, and certainly for some of the more questionable ways of innovating IPOs that we've been seeing the past year.
Jim, we're out of time, but I have like a million more questions, so you have to join me again, maybe next week. Chatham House Chair and former Manchester United non-executive director Jim O'Neill. Now, the SEC and Archegos are in full focus. U.S. regulators are set to examine their fund disclosure rules after Bill Hwang's family office implodes. We get more details on this Bloomberg scoop next. This is Bloomberg. Regulators
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Archegos was a situation that is now being reviewed also by US regulators. It was a very idiosyncratic situation with a family office which had some deficiencies in terms of disclosure. And there were 6 or 7 other brokers involved in that, so it was certainly not only a Credit Suisse issue, but we certainly had higher exposures than others.
Well, that was the Credit Suisse Chief Executive, Thomas Gottstein, speaking to us earlier as the SEC is said to be investigating new rules for disclosure. Now let's get straight to Danny Berger. Danny, what exactly are the changes that the SEC are examining?
The goal here, Francine, is really allow them and Wall Street to spot any oncoming risks in the system. And it does seem like a pretty clear reaction to some degree to Archegos. For example, some of what they want are perhaps more disclosures, better disclosures, and more frequent disclosures. So, for example, if someone's using a swap, that should be disclosed as well as short positions, Francine.
Danny, thank you so much. Our Danny Berger there with some of the rules possibly changing. Now, stay with Bloomberg Surveillance, the early edition. Next, we speak to the UK Business Secretary on Earth Day. This is Bloomberg.
generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Big tech such as Alibaba and Tencent are no doubt national champions, but now China is stepping up oversight. Just how far will the Chinese government go on regulation? We'll explore on a Bloomberg special, Red Lines, China and Big Tech.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Credit Suisse slides as Thomas Gottstein tells me the damage from Archegos will spill over to the second quarter. The Swiss lender raises $2 billion to shore up its finances. More from that interview with the chief executive shortly. The Swiss regulator begins enforcement proceedings against Credit Suisse after the blow-up. Gottstein says the bank is in constant dialogue with FINMA. And Bloomberg learns the SEC is considering tougher disclosure requirements for firms in response to the implosion of Archegos, while derivatives and short positions may be added to current filings. Well, good morning, everyone. I'm Francine Lacqua here in London. Welcome to Bloomberg Surveillance, the early edition on this Thursday, the 22nd of April, also Earth Day. Now, it's been a tough year for Credit Suisse, which has been rocked by one scandal after another. The bank's first quarter results this morning may have been better than expected, with a net loss of 252 million Swiss francs, but they say losses of 600 million from Archegos won't be seen until the second quarter. Well, I spoke to the chief executive, Thomas Gottstein, earlier about the Archegos collapse.
We have addressed most of the issues now. Archegos, we are down to the last 3%. We have exited the positions to a large extent. And we have raised almost $2 billion with a mandatory convertible this morning. We have taken action in our risk organizations. We have taken management changes. So we have done quite a lot. Still some work to do in the second and third quarter, but we have taken a lot of measures.
So why did you arrive to the decision of doing a convertible bond instead of doing something else or just raising capital outright?
Well, we had conditional capital. That's the best way for us to raise the equity. It's a short 6-month maturity. It was important for us to basically get to a 13% CET1 ratio, which on a pro forma basis we now have. And that was important for us to take the capital discussion off the table.
So what concrete measures are you actually taking to reduce risk, especially in the prime brokerage business, beside tightening financing conditions?
We are going through the entire portfolio. We have already started to reduce the risk. Our plan is to reduce leverage exposure by 35 billion by the end of the second quarter in this business. And we will take further action in terms of control systems, both on the first line of defense as well as in the second line of defense.
Before Archegos, you also warned of a possible financial hit from Greensill. What's your best estimate on that?
Greensill, we are working through with the administrator of Greensill Capital. We have brought back 5.4 billion in terms of cash out of the original 10 billion. We have good visibility for a large portion of the remaining positions. There are 3 more distinct positions which we'll work through over the next few months and quarters. We are not planning to do any form of step in. We are very clearly focused on getting the cash back to our investors. That's our priority.
So what is the status overall of the 2 reviews? And because of these 2 incidents, do you see any further personnel changes?
No, we don't foresee any other personnel changes at this point in time, but we obviously are doing an investigation. The board is doing the investigation, and we will inform about that outcome when we are ready to do so.
Well, Credit Suisse Chief Executive there, Thomas Gottstein, speaking to me a little bit earlier. We'll bring you more from that interview throughout the day right here on Bloomberg TV. Now, today also marks the 51st celebration of Earth Day, and U.S. President Joe Biden is bringing together dozens of foreign leaders for a 2-day virtual climate change summit. The event marks America's return to the international climate stage, and speaking yesterday at a virtual conference, the U.S. Treasury Secretary Janet Yellen said the overall cost of reaching the Paris Agreement could run to $2.5 trillion in the U.S. alone. The outlay, of course, could prevent further losses in the future.
Over the past 30 years, the incidence of natural disasters has dramatically increased, and the actual and future potential cost to the economy has skyrocketed. We're now in a situation where climate change is an existential risk to our future economy and our way of life.
Well, at the same time, the UK has laid out plans to cut carbon emissions by 78% by 2035, one of the most ambitious targets globally. Well, joining us now is Kwasi Kwarteng. He is the UK Business Secretary. Secretary, thank you so much for joining us today. Now, the UK has very ambitious plans to cut carbon emissions.
That's right.
If you look at what you just laid out, it's basically cutting them by 78% by 2035 from the 1990 levels. How difficult will that be, and what are you doing to try and achieve this?
So, Francine, you're absolutely right. It's a challenging target, but we feel that we can hit it. And as you say, it's a 78% reduction from 1990, which is the base year. And I think people should realize that as of today, 2021, we've actually reduced carbon emissions in the UK by 45%, nearly 45% from 1990. And that's why it's that progress that's allowed us to have an ambitious target of 78% reduction by 2035. So the 78% figure wasn't just plucked out of thin air. Yeah. It relates to a lot of the work that we've already done in this vitally important area of decarbonisation. And you're right, there are other things that we have to do. I think we have to accelerate the pace of decarbonisation in other areas. We've had success in reducing carbon emissions in power generation. We've successfully almost eliminated coal from our electricity grid. But there are other challenges in areas such as heat and buildings and in transport. But again, I think in transport we have policies, we have a very strong program to eliminate ICEs, internal combustion engine vehicles, cars, by 2030. And hybrids by 2035. So these are the kinds of policies that we are driving here in the UK.
So the committee basically laid out some things that would help in achieving this, which are extremely difficult. First of all, I'm looking at phasing out gas boilers by 2033. I'm also looking at, for example, the need for people to consume 20% less meat and dairy by 2030. How achievable is that for the government?
I think these are challenging targets. No one would deny that. But if you look at, for example, the consumption of meat and dairy, a lot of the change is happening by society anyway. I mean, if you look at our diet, I don't know about your viewers, but if you look at lots of people's diets, we are consuming a lot less meat than we have done, certainly in the recent past. More people are adopting vegan and vegetarian lifestyles. And this is happening through social action. This is happening through people acting as individuals and in communities. It's not been driven by government legislation. So a lot of this change, I think, will come about through individuals, people actually making their own decisions. And when we say, the committee says it'll be a 20% reduction in meat, a lot of the reduction is happening already in terms of meat consumption. And people are adopting a more carbon emitting or less carbon emitting lifestyle.
Minister, you've also scrapped the Green Homes Grant. Is that not low-hanging fruit?
So the Green Homes Grant, elements of it, of the scheme, have been successful. And as you say, there's a portion which I essentially ended. And I looked into this as Business Secretary, and the rollout wasn't as fast as we would like to have seen. But across the £3 billion that was earmarked, I mean, half of that, the £1 billion for public sector buildings decarbonisation, has been successfully deployed. The £500 million, which has been given to local authorities to distribute to improve social housing and low-income households, the housing of low-income households, that has been effectively distributed. The half of the scheme for owner-occupiers, as you say, hasn't been as effectively rolled out. And I made the decision to end it when the contract actually ran out at the end of March.
Minister, what are you doing in your own life to cut your carbon footprint?
Lots of things. The car that I use is a hybrid vehicle. I'd like to move it to fully electric. I'm certainly reducing my meat consumption. not only because for environmental reasons, but also for health reasons. I'm eating a lot more fish than I ever did before, but maybe I can move to a full vegan diet at some point. These are the kinds of changes that lots of people, millions of people are thinking about. And lots and lots of people are actually adopting these lifestyles. And I think in the future, there'll be, again, a much greater take-up of that kind of approach to diet.
Minister, I also need to ask you a little bit about some of the, AstraZeneca vaccine and certainly some of the spats that we've been seeing between the UK and the EU. So how are those talks going? And do you worry that, there's still a chance that the EU blocks exports to the UK like they've threatened in the past?
I think there have been threats and there have been, warm words exchanged or strong views. I think the position we're in now is much better than it was a few weeks ago. We're trying to cooperate, but obviously we have a job to vaccinate and keep our people here in the United Kingdom safe, and that's what we're focused on. And the vaccine rollout, as you probably know, in the UK is going very well. I think as of today, something like 42 million people in the UK have received the first vaccine. The death rates, hospitalization rates have the roadmap that the Prime Minister sketched out.
Well, Minister, we just got you back. We had a slight connection delay, but yeah.
Sorry about that. Yeah, I mean, I was just saying that I think the relations, the dialogue we're having with the EU is in a much better place than it was 2 or 3 weeks ago. And we're very focused here in the UK of getting the vaccine rollout. It's working well, but we want to make sure that we do it effectively so that we can reopen the economy on the dates that we've outlined.
Minister, thank you so much for your time. Kwasi Kwarteng there, the UK Business Secretary. Now, coming up, it's also European Central Bank Decision Day, ECB Day. Investors are waiting to hear how much longer the euro area will need intensified support. That's coming up next, and this is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Well, we have conditional capital. That's the best way for us to raise the equity. It's a short 6-month maturity. It was important for us to basically get to a 13% CET1 ratio, which on a pro forma basis we now have. and that was important for us to take the capital discussion off the table.
Well, that was Thomas Gottstein speaking to me this morning. Credit Suisse stock has been falling in today's session, the biggest laggard on the stock 600. Now, it's ECB day, but the Governing Council is not expected to make changes to interest rates, asset purchase programs, or bank loans just yet. President Christine Lagarde is under pressure to reveal how much longer the euro area will need intensified support. Well, joining us now is George Saravelos, Deutsche Bank Global Head of FX Research. George, you also have a great note out, which we'll get to in a second, but overall, what do you think is the main challenge for Christine Lagarde today?
Good morning, Francine. I think the ECB meeting today is likely to be a placeholder, really, for June. The vaccine rates in Europe are picking up pretty dramatically. It's one reason why we've been on the optimistic end for Europe. But I think they still need to see more evidence that the rollout is happening, that the lockdowns are going to be lifted. Indeed, Italy just announced some potential lifting overnight. But I think for now it's going to be a placeholder, and the more significant meeting will be in June, where it is likely the ECB reduces the pace of bond buying.
George, one of your euro-dollar calls was actually the correct one. So what happens to euro-dollar after it reached 120?
I think, Francine, the euro can go up to 125 over the summer. We are euro optimists. There's two things really turning in favor. So the first quarter of the year, I think, was America's quarter, so to speak. I think the second quarter will be Europe's. On the one hand, we knew the vaccine supply will pick up, but it is being delivered. The shots are being injected into people's arms. And you've seen a pretty dramatic increase. Europe now is vaccinating at a faster pace than the US. And then on the other, the economy is proving very resilient. So I'm very focused on the future output component of the PMIs, which are near 70. They're suggesting a very, very big bounce back to European growth. So the market repriced US reopening in Q1. I think it will price European reopening in Q2 and a very, very pleasant European summer, hopefully.
So this is not, all about U.S. yields, which is also what you argue in your recent notes.
I think the first quarter of the year was about U.S. yields, but as we rotate into the second quarter, the growth recovery will broaden out. It will become much more inclusive relating to Europe. So if you do see potential moves higher in yield, it won't just be in the US, it will be in Europe as well, which will prevent the dollar from strengthening. But the other critical part is, if you look at the relationship, the correlation between long-term yields in the US and the dollar, it's very, very weak. They're not that relevant. What matters is the Fed and front-end rates, and as long as the Fed is dovish, I think the dollar will find it difficult to rally. And the point to make there is the U.S. output gap, U.S. GDP, has had one of the fastest recoveries. But the labor market in the U.S. had the weakest recovery among the G10. The labor gap, so to speak, is the biggest versus the output gap, which is the smallest. And I think that will keep the Fed dovish.
George, yesterday we had the Bank of Canada, right? The first big central bank talking about tapering. Does that put extra pressure on other central banks, or is it, just a one-off?
So I think it's a fascinating comparison to make, Francine, Canada and the other central banks. And one interpretation yesterday was the central bank was very hawkish. But that was not really true, because the Canadian labor market has had a remarkable recovery. It's only now about 1% in terms of payrolls from peak. But if you compare it, for example, to the US is way, way behind in terms of the labor market recovery. Other central banks, I think, are likely to face pressure quicker because the labor market recovery has been quicker. So I would put Australia in that bucket, even potentially New Zealand, Norway as well. So it's where the labor markets are growing and recovering the fastest, where I think central banks will turn hawkish quicker.
Great. Thank you so much. George Saravelos there, Deutsche Bank Global Head of FX Research, joining us. Now, it's also Earth Day, and up next, we speak to the Chief Executive of Klarna about what fintech firms can do to support the planet. That conversation is up next, and this is Bloomberg.
model minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy, and we need companies to step up.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, it's Earth Day today, and as U.S. President Joe Biden pushes to aggressive global emission plans, Swedish fintech firm Klarna is launching its new sustainability initiative. It will give its 90 million users the ability to track their carbon footprints as they shop. Now, joining us now is Sebastian Szymanowski. He's a Klarna chief executive and co-founder. Sebastian, thank you so much for joining us on Earth Day, and we hope a lot of the initiatives will actually make a real difference. How have customers received this? Did they want this because they want to be more conscientious?
Oh, yeah, absolutely. I mean, it's pretty amazing when you ask, like, especially Gen Z and millennials today, they're putting this as the top priority for their decisions. But again, I think it's important to highlight, we're not doing this big, only because, I think a lot of people want to say, it's good for profit, it's good for business. We're doing it because it's morally right. I don't need to motivate everything I do with profitability. It's fine to just do things because they're the right thing to do.
Yeah, but that's fine because you're not listed. I don't know whether you have IPO plans and whether that will change once you do.
Well, I do think hopefully most listed companies as well don't only do things for profitability. They do things also because they're morally the right thing to do, right? Just because something might be profitable, but bad from a moral perspective, don't do it. But coming back to do consumers like this? Yes, I think one of the things that we realized was really clearly what can Klarna do as a bank, as a payments company? How can we support people taking better decisions? And we realized that today, we've seen amazing protests, people going into the street protesting, Greta Thunberg and all these amazing movements. But so we said people doing that really well. What can Klarna do? Well, we realized that, there's few things that are as powerful when people vote with their wallets. If people start buying this instead of that, companies take notice fairly quickly. Yeah. So we said, okay, what if we could, show transparency, show everyone what you're purchasing, what is the carbon footprint of that decision? And then that will help people and make it more transparent. Like when you're buying groceries, how much
Which is great. Yeah, which is exactly what you need because actually, a lot of people are trying to be better like me, but actually you often don't have the tools. So how do you track it? If I buy, so let's say I buy a sweater and I use Klarna, do you track the making of it or do you track actually from the moment I buy it to when it comes to me, how much carbon emissions that does?
Yeah, so like everyone else, when you get into something like this, you're like, oh, let's do it. It's an easy grade. And then you get into the details and whoa, this is complex. There's a lot of details to this. So what we realized, to get something out there, we teamed up with Doconomy and Ålands Index, which is people that have already done amazing work to try to start creating some models. They're still fairly, they're not that granular. They're not that detailed yet. They're fairly, giving you an approximate per customer category, purchase category. But then what we're going to do now is we're going to improve on this, right? So, for example, one of our merchants comes back and says, well, you know what? I'm sustainable. What you're saying, that's a too high number. Here's the proof to show you that it's lower. Okay, let's adjust it, right? Or we're learning as we're getting into the details. So this will not be perfect from day one, but we need to get it out there first. Let people try it, test it, tell us, give us the feedback, and that's how we will improve it. And over time, hopefully, it will be super, super accurate.
Sebastian, over time, is this really another part of your business? I mean, do you see it as an add-on, or could this actually be a second part?
No, this is part of our business, because if you think about like what we think is, the traditional banking has been about return on assets, return on equity, charging consumers as high interest as possible and pay as little interest as possible, right? It's not really a great business model for the rest of society, because that's what's created a $8 trillion banking industry, which is creating like, I don't know how much value for society in general for just shifting money back and forth. So what we realize is the future of banking is taking the data that customers have decided to share with us and use that data to help customers take better decisions, whether it's saving them time, saving them money, making them less worried about their finances, or taking better decisions from a climate perspective or a biodiversity perspective. So to us, this is core. And we also have, very different from everyone else in the payment space, on every transaction, we have SKU level data. We know not only that you bought for $100, we know what items you bought. So we said, well, you know what? If we have all of that data, that's actually making us very well positioned to be a leader in it and help people, give them that transparency.
Sebastian, thank you so much for taking the time to come to speak to Bloomberg on Earth Day. Sebastian Schmittowski, their Klarna chief executive and co-founder. Bloomberg surveillance continues. This is Bloomberg.
Renewed global attention on the fact that the efficacy levels of Chinese vaccines have not reached the levels that we've seen from the mRNA vaccines in Pfizer and Moderna, and even Russia's vaccine. All of these have efficacy levels above 90%, but the Chinese vaccines are ranging between 60-something% to just below 80%. And specific attention is being paid on one Chinese vaccine, Sinovac. This vaccine has been proven in a large-scale Brazil trial to have an efficacy level of just above 50%. 50% is the minimum threshold that regulators will accept for approval. So that is concerning, especially because this is the Chinese vaccine that's been distributed most widely around the world. A lot of developing countries like Brazil and Indonesia are dependent on this vaccine. So questions are starting to mount on how is this going to affect the global immunization effort. But what's also really important to keep in perspective is that the 50% efficacy rate is looking at all symptomatic disease, even mild sickness. And the truth is that all the vaccines we have out there right now, including the Chinese ones, are nearly 100% effective at preventing hospitalization and death. And those are the two most important things: bring down serious sickness, bring down fatalities. We're still going to see that happen around the world, and that's why it's really important for people to keep getting vaccinated, even if the only access they have is to a Chinese vaccine.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
We We have addressed most of the issues now. Archegos, we are down to the last 3%. We are going through the entire portfolio. We have already started to reduce the risk. We're in constant dialogue with regulators here in Switzerland, but also in other places. Archegos was a situation that is now being reviewed also by US regulators. It was a very idiosyncratic situation with a family office. We are all responsible for what happened. It's now our job to take Credit Suisse to the next level.
This is Bloomberg Surveillance, early edition, with Francine Lacqua, Matt Miller, and Keely Lines.
Well, good morning from London and New York on this Thursday, April 22nd. Our top stories today. Feeling the pain, Credit Suisse warns it will take another financial hit from the Archegos collapse. The bank is raising $2 billion to shore up capital. SEC crackdown. U.S. regulators are considering tougher disclosure rules after the Archegos implosion and GameStop's wild ride. And staying the course, the European Central Bank will probably decide to keep buying bonds at a speeded up pace to support the economy. So I'm Francine Lacqua here in London, Keely Lines in New York. Matt Miller actually off today. Keely, I have to say, dominating all news is still kind of what we're expecting from the Football League, but actually it's Credit Suisse, and we now hear about extra regulation from the US, of course, from Germany. It's not the only market story, but certainly it's the biggest loser in Europe right now.
Yeah, it absolutely is, Francine. I mean, Credit Suisse shares are down about 6% in the European session at the moment, and if you type read go into the Bloomberg terminal, all of the top stories this morning are about Credit Suisse. So that is definitely front and center, and we will continue to watch that stock in particular throughout the European trading day. I do, though, want to recap what we saw in the overnight session, because we did see a bit of dip buying coming into Asia, specifically in Japanese equities. The Nikkei was down 2% yesterday. Today, though, it closed 2.4% higher. You also had Hong Kong and Australian shares in the green. A little bit of underperformance, though, for Chinese equities. In the FX market, the Japanese yen, once again, one of the outperformers in the G10 space, giving back some of its gains, but still stronger against the dollar, right at a 108 handle. We broke through that earlier today. The big underperformer in G10, though, is the Kiwi, the New Zealand dollar, weaker against the US dollar by about 0.5%. In the European session, it is green really across the screen. Everywhere you look on Map Markets Go on the continent is green. The DAX up by about 0.5%, the CAC 40 as well. UK stocks in the green, and the Stock 600 isn't at a record high, but we are just shy of those levels as it gains for a second day. Of course, European assets across the board really in a bit of a holding pattern ahead of that ECB decision coming up at 7:45 a.m. Eastern time. Ahead of that, the euro basically flat against the dollar, sitting at 120.25, and the German 10-year bund yield down about a basis point to negative 27 basis points. Here in the U.S., we saw that dip buying coming in yesterday, but it doesn't look like there was really strong follow-through on that this morning. Futures essentially flat, but down 4 points on S&P E-minis. The 10-year yield, really interesting story. It dipped below its 50-day moving average earlier, around 1.53%. Now, though, yields moving higher. We're sitting at 1.55%. That was weighing on the dollar earlier, but it is now gained back some strength. Doesn't seem to be helping crude, though. Still down 0.7%, right under $61 a barrel, Francine.
Kaylee, now let's also look at what's ahead today. The ECB releases its latest rate decision this morning, followed by a press conference by President Christine Lagarde. After that, we get U.S. initial jobless claims. Also today, President Biden hosts a virtual climate summit for Earth Day with 40 world leaders. We get first quarter earnings from American Airlines, Southwest, and Intel. Now, I'm always looking forward actually to what the ECB has to say, but I have to say this time, Kaylee, it seems that they're not going to, put any sparks out there. So this will, as far as we know, really trying to lay the groundwork for June, where we could have a bit of tapering, but Christine Lagarde probably wants to just try and understand what the mechanisms of the economy are going forward, given the vaccinations are accelerating a little bit in Europe.
Yeah, I think that's right, Francine. Obviously, none of the big forecasts will likely come until that June meeting, but I am interested to see what Christine Lagarde's tone is, especially after the Bank of Canada yesterday was taking steps toward normalization. Yes, it is baby steps, but still, when you have the Bank of Canada going in that direction, I wonder if they're outlining a kind of path for what tapering is going to look like for the ECB when it does eventually come, Francine.
Yeah, we just had a great conversation also with George Saravelos of Deutsche Bank, who's making that very point, Kaylee, that actually it's a big deal looking at the Bank of Canada. It's one of the major central banks and definitely the first to taper. What does it mean for the other ones? Do they feel a little bit awkward about, their own path or how they talk to the markets? And Christine Lagarde, I bet you will be asked a lot about regulation of prime brokerages. Now that ties back to Credit Suisse raising about $2 billion to shore up capital. That's after warning of another financial hit from the Archegos collapse. Now, we spoke to the Credit Suisse Chief Executive Thomas Gottstein earlier today.
Archegos was a situation that is now being reviewed also by U.S. regulators. It was a very idiosyncratic situation with a family office which had some deficiencies in terms of disclosure. There were 6 or 7 other brokers involved in that, so it was certainly not only a Credit Suisse issue, but we certainly had higher exposures than others.
Well, let's get straight to Sonali Basak, our Bloomberg Wall Street reporter, who's also been breaking a lot of news around the story. Sonali, so when I spoke to the chief executive, I have to say he was brave to actually come on, and they were brave to put him up in such a difficult time. But he was actually very thin on details. What exactly are they waiting for? Is it really the arrival of the chairman to look at new strategies, or is it simply because they're tied because of these reviews and these investigations?
It's a little bit of both, Francine, because actually there's some losses that could start to materialize that they can't even talk about yet. Think Greensill, right? There's also a lot of uncertainty when it comes to any potential lawsuits ahead. What will litigation risk look like, and what will regulatory enforcement risks start to look like? All of that uncertainty tied to this capital raise, which was really one of the worst case scenarios, and something that, a lot of folks were saying they do have the regulatory capital to withstand, and you really see one of the worst cases here with an additional layer of a lot of uncertainties ahead for this bank.
Yeah, a lot of uncertainties ahead indeed, Sonali. Bloomberg Wall Street reporter, thank you so much. Now, of course, U.S. regulators are also looking at enforcing tougher requirements for investment firms. The changes are largely a response to this year's implosion of Archegos and the wild trading in GameStop. Bloomberg's Danny Berger joining us now with that scoop. Danny, what changes exactly are the SEC examining?
Well, really the goal here, Kaylee, is to allow the SEC regulators and really Wall Street as a whole spot any potential risks that could be building in the system. So as you say, a direct response from Archegos. So a lot of this has to do with more disclosures and transparency. That is looking at different funds having to disclose the derivative positions they hold, which is, of course, what Archegos had, the bets that eventually went the wrong way. At the same time, perhaps filing 13Fs more frequently, not just quarterly. And do family offices also need to have more disclosures than they currently do? Now, the other part of this is somewhat a response to GameStop as well. You'll recall a big part of that was that GameStop had more than 100% of shares shorted. So one potential proposal here could be disclosure on funds who hold different shorts. Of course, at the moment, they don't have to do that. There's been some criticism from that from the hedge fund and active fund space, but these are early days, sources tell us. We had Gary Gensler, the SEC chair, just coming in over the past week, and he's going to take really the pace. He's going to be dictating the pace of this. So at the moment, nothing concrete yet, but it is certainly something the SEC is looking into.
Yeah, and something we will be closely watching as well. Bloomberg's Danny Berger, thank you so much. I do want to take a quick check on some stocks moving in pre-market trading in the U.S., all tied to earnings. We have a number of outsized movers to the upside, one of them being Teradata. It is a database management company surging nearly 30% in early hours after a first quarter beat after the bell yesterday. Earnings per share of 68 cents, handily topping the 39-cent estimate. Qualtrics also sharply higher after its results. The software company guided second quarter revenue above expectations. That stock up 16% as a result. Kinder Morgan reported a blowout first quarter profit, thanks very much to that deep freeze we saw in Texas earlier this year. That stock is higher by about 3%. And Churchill Downs also higher after a big beat. It, of course, is the horse racing company, Francine. And a friendly reminder to our audience, the Kentucky Derby is taking place next weekend, Francine.
Oh, Kentucky Derby, you put money on it? I'm not the best at this, but sometimes I get one or two things right.
I think you're better than you give yourself credit for, because you came very close to taking the cake in the March Madness tournament. So maybe sports betting is going to be your new thing.
Maybe. I mean, luck is always on the side of people that don't know anything about anything. Coming up, we'll talk equities with Peter Oppenheimer. He's Goldman Sachs Chief Global Equity Strategist. And then after that, more from our interview, the Credit Suisse Chief Executive, Thomas Gottstein. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Francine Lacqua in London. Matt Miller is off today. Francine, I want to talk about a dynamic we're seeing in the equity market. It's a bit of a change to what we've been seeing recently, and I have a really great chart on the Bloomberg terminal that shows this. For our audience listening on DAB Digital Radio in London, I will describe it for you. It is really pretty straightforward. As the MSCI Growth Index relative to the MSCI Value Index, the spread between their performance. And really for the duration of 2020, it was growth that was beating value. We started to see that change in November when positive vaccine news started coming out, and value beat growth by 4 percentage points in both January and February and March, and then in April, things have started to change. Now it is growth that is actually topping value by about 4 percentage points. So that rotation everyone was talking about coming into 2021 is starting to rotate back. This may be mostly an earnings story for Francine, but definitely an interesting dynamic to watch in the equity market.
Yeah, it certainly is. I mean, there's so much to watch, actually, in the equity markets. Today, it's all about the banks, and then there's all this money actually looking for yield. Now, joining us, we're delighted, is Peter Oppenheimer. He's Chief Global Equity Strategist at Goldman Sachs. Peter, as always, thank you so much for coming on. Now, you also have a great note out, which is called The Bubble Puzzle, a guide to bubbles and why we're not in one. Do you worry about frothiness at all?
Yeah, Francine, I do. I mean, there's certainly some signs of exuberance. Bear in mind, we've seen one of the strongest rebounds in equities of all time from a bear market. And, we're seeing a higher proportion of many equity markets made up of companies with very high valuations, EV to sales above 20, for example. And there's also the very rampant activity that we've had in M&A and SPACs and so on. But when you look at it in the round, and we've tried to look at some of the common characteristics of bubbles going back over 300 years, while we've got some of the characteristics being met, we certainly don't have all of them. Bear in mind, you normally get very significant rises in leverage, private sector leverage during bubbles. That's something we don't have. You know, household balance sheets are very strong, banks' balance sheets are very strong. And while valuations have gone up a lot, for example, in equities, absolute valuations are very high, you still got a pretty high risk premium. You know, bear in mind, back in the late 1990s, investors were buying the S&P on a dividend yield of 1% when the risk-free 10-year bond yield at the time was 6 to 6.5%. That was the sense of optimism people had then. Very different now. So I don't think we're in a bubble overall.
Peter, what makes you nervous, though, about the future? So is there too much risk out there, even if we're not in a bubble, because maybe it goes into parts of the markets, you know, that are not the traditional, let's say, markets? Is there a danger that it affects liquidity?
Yeah, I think there's certainly some tactical risks. You know, we have things like a risk appetite indicator, which is made up of 27 different pairs of risk versus less risky expressions across all the main asset classes. And this has reached very elevated levels. In other words, in general, sentiment, optimism, positioning has become very high. And that leaves the markets to be somewhat vulnerable to disappointments, at least in the near term. You know, where those disappointments could come from, difficult to say. Most likely, the biggest risk in the near term would be that this anticipated strong growth that the market has started to price in just doesn't come through as quickly. And I think that would create a pullback in equities, particularly in some of the things that have recovered most strongly. But in the broader sense, I think we have to look at the position of where we are in the cycle. We're still coming out of one of the deepest recessions in history. Markets priced a lot of recovery, but we're really at the very early stages of an economic expansion. And I think that we're transitioning from what is the sort of first phase of a bull market, what we call the hope phase, where all of it is about expectations, valuations go up, into a more sustainable growth phase. And that tends to bring with it lower returns.
So then why have we seen this flight to quality in recent weeks, Peter?
Again, I think this is a bit of a sort of traveling and arrival type situation. You know, in the last few months, as you say, particularly prompted by the optimism around vaccines, we saw a strong rotation into the laggard parts of the market, things that were more operationally levered to a recovery, cyclicals, cheaper stocks, value. But as you start to get that recovery coming through, I think there's a sort of tendency to hold back and wait to see how much of the expected recovery is really emerging. And also we're in earnings season. There's a lot of focus on what companies are saying about the future, not just the results right now. So I think it's natural that you get a bit of a pull back towards some of the previous winners, many of which have seen their relative valuations coming down as well to some extent.
Well, as you say, Peter, it really is all about the outlook. And we're getting a number of companies, specifically those in the consumer sector, start to talk about input costs and rising commodity prices. Do you expect that these companies are going to be able to exercise pricing power and that margins aren't going to be an issue?
I think in the consumer-facing areas, there will be fairly decent pricing power. After all, you know, people have been locked up, unable to do the things that they've wanted to do for such a long time. And one of the positive things, at least of the policy support that we've seen over the last year, is that savings have built up. So there's an ability in aggregate for consumers to get back and start to participate, enjoy themselves again, leisure, entertainment, perhaps travel. And I think the pricing power will be reasonable in those areas. But I think it would be wrong to say that that means that aggregate inflation is really going to pick up a lot. I think there'll be relative winners and losers here. There are some technical factors pushing inflation up in the near term. But as central banks continue to say, the broader excess capacity issues that we have suggest that we're not really going to meet the broader characteristics required for liftoff, for tightening policy, for raising rates, still for some quite a long period of time.
Peter, when you talk about the reflation trade and some of the concerns out there, and you look at what the Bank of Canada announced yesterday with the tapering, if we do hear talk, or at least a guideline for the markets on when the ECB could start thinking about it, or some of the other major central banks, do you expect an aggressive repricing of equities?
No, I think that there's an expectation that we will begin to see some tapering, probably not until next year in the US, and maybe a slowing of pet purchases in Europe in the next quarter or so. But I think this is going to be very gradual, actually. And again, you know, when you look at where inflation is relative to what the central banks are telling us that is required before they really start to tighten policy and raise interest rates, those conditions are not likely to be met for really quite a long time, even in the US, where we're entering really a very, very strong quarter of growth, where unemployment has already come down quite a long way. We're still not likely to reach the sort of full employment and inflation, you know, consistently above 2 to 2.2%, probably at least until the sort of second half of 2023, and in Europe well beyond that. So I don't think that you'll see the kind of rapid withdrawal of liquidity or support from central banks that could cause a significant hiccup. I think the bigger risk, at least in the nearer term, is on growth not coming through as strongly as expected. Our own view is, though, that it will come through strongly, and that equities and risk assets will continue to outperform, but at a much more modest rate as we go into that fundamental growth phase where the actual profit growth starts to come through.
Peter, thank you so much, as always. Peter Oppenheimer, their Chief Global Equity Strategist at Goldman Sachs. Now, coming up, Global Tipping Point, Bloomberg hosts a summit on the power of global capital markets in the fight against climate change. Speakers include the U.S. Treasury Secretary Janet Yellen, ECB President Christine Lagarde, and the UN Special Envoy on Climate Action and Finance, Mark Carney. That starts tomorrow, 10:30 a.m. in New York, 3:30 p.m. in London, and this is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also, like, you know, we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, you know, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
We're early on in this year. I know we've already sort of penciled in 6 or 7% growth and a big fall in unemployment, but under outcome-based policy, we really want to see that.
I'm bullish on the rebound, but I know we have a long way to go before the job is complete.
There's no textbook for this. You don't want to be too preemptive, but I also don't want to be so reactive that we're late.
I think it's too early to talk about changing monetary policy while we're still in the pandemic tunnel.
Countries that entered this crisis with limited fiscal space
with more vulnerabilities need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua in London, Kaylee Lyons in New York. Matt Miller off today. Now let's get straight to the Bloomberg. First word news, and Joe Biden is said to become the first U.S. president in 40 years to recognize the mass killings of Armenians as genocide. That runs the risk of upsetting an already fragile relationship with Turkey. Well, Bloomberg's learned that the president's announcement will likely coincide with Saturday's Armenian Genocide Day. The killings took place under the Ottoman Empire, which later became Turkey and various successor states. Now, the new surge in coronavirus infection is not threatening to further divide the world economy between the rich and poor. It could damage overall global growth if the fresh outbreaks spread or if key sources of demand falter. More people were diagnosed with COVID last week than any other since the pandemic began. And the European Union's executive arm is preparing a legal case against AstraZeneca. Bloomberg's learned it has to do with the drug maker's failure to deliver its promised number of doses to the bloc. AstraZeneca delivered just 30 million of its original committed 120 million doses to the EU in the first quarter. I mean, of course, the question is then, even if they did produce more, who would take them in the EU, as there's quite a pushback against this vaccine. Also, it's ECB day today. Now we'll discuss what to expect with Holger Schmieding, Berenberg chief economist. I know we'll talk about Euro. We'll also talk about the Bank of Canada, one of the first major countries to actually talk about tapering. This is Bloomberg.
Flagship store in New Delhi. The iconic British toy store chain is set for a revival as the new owner and billionaire Mukesh Ambani looks to expand the brand in India. Quadruple the number of outlets in India to 500 in 3 years. The expansion of Hamleys will help Ambani widen his retail portfolio as he transforms the oil and chemicals conglomerate into a consumer and technology giant.
I think certainly it is gaining popularity since last few years, and now more and more people are coming to Hamleys because it has a wide range of toys for all the age groups.
Founded in 1760, Hamleys has been struggling to make profit for a long time, and the pandemic has worsened its financial distress. The deep pockets of Asia's richest man and India's demographics could help Hamleys revive sales.
seeing during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua in London. Kaylee Lyons in New York. Matt Miller off today. Now, there's a lot going on in the markets. I know, Kaylee, actually, there's a press report here in the Telegraph saying that the UK could distribute vaccination passports for people to be able to travel. And so a lot of people are thinking also about travel plans. I know we were discussing it in the break. And, if it's not directly impacting markets, it could certainly make some of the travel companies take off.
Well, I think it is impacting markets in a way because you had so much optimism built into those travel stocks as we came in to 2021, and then we're just coming off, I think it was 10 straight days of losses for the S&P 500 airline sector, as there's still those concerns about when international travel is going to come back, and I myself am grappling with this as I try and decide if I'm going to buy flights to Ireland or not for this summer. So TBD on that. Still waiting. I have a poll out on Twitter if you would like to vote. As for what is happening in the broader markets, we are looking at a second day of gains for the Stock 600 in Europe, not at record highs, granted, but still up about 0.6%. Here in the U.S., after some buying of the dip yesterday, we aren't seeing really strong follow-through. Futures down 3 points on S&P E-minis. In the Treasury market, the 10-year yield breached its 50-day moving average earlier in the session, fell as low as 1.53%, but we're back up to just shy of 1.56%. And then, of course, we're watching European assets today ahead of that ECB decision in about 2 hours in 15 minutes time. Right now, the euro essentially flat against the dollar ahead of that. Now, I would also note that Bitcoin continuing its losses today. It's sitting around $53,000, and that is weighing on some cryptocurrency-tied stocks in pre-market trading. Riot Blockchain, Marathon Digital, your usual suspects, down about 6% and 5% respectively. As we know, Francine, Cathie Wood over at ARK Invest is a big crypto bull, and she also is apparently bullish on a few stocks, and her ARK funds buying those shares, sending both Skills, the video game maker, up by about 9.5% in pre-market trading, and then Arrival Group. This isn't one that Cathie Wood had bought, but that stock, of course, an EV company, is higher by about 9%, Francine.
Yeah, Kaylee, I mean, it's all about that. And of course, we also have the ECB and Lagarde's Balancing Act. Now, the Governing Council today of the European Central Bank is not expected to make changes to interest rates, asset purchase programs, or bank loans just yet. President Christine Lagarde is under pressure to reveal how much longer the euro area will need intensified support. Well, joining us now is Holger Schmieding. He's chief economist at Berenberg. Holger, is this really a balancing act so that we understand, we were just talking about flights and whether we should book flights. I mean, this goes kind of to the heart of the matter of what the European Central Bank needs to figure out, right? How much longer will the economy stay in this, almost standstill, and when it's revved up to go?
Well, for the flight plans, I would probably start to book a few flights for summer or late summer, as it's likely that with the vaccination progress in Europe, we'll be able to reopen, at least to such an extent that fully vaccinated people will be able to have a full summer holiday. As to the European Central Bank, it will be a balancing act, but probably in June rather than now. Today, the ECB can really take it easy. Nothing much has changed since the March meeting, and there is no real pressure on the ECB to divulge anything new today. Inflation is a bit higher than the ECB may have expected, but that can be explained by special factors. The economy is sort of on track, but we don't quite know yet. We have to wait for the further vaccination progress picking up now, but we have to wait for it. So the ECB can probably just afford to say, let's meet again in June, and we'll tell you more at the time.
The Bank of Canada was the first one to start to taper. Is it a one-off, a one and done? And does it put extra pressure on the ECB to have that conversation with the markets?
Well, I don't think the Canadian decision puts any pressure on the ECB. Canada is so closely linked to the US, where we have this massive fiscal stimulus spilling over, that of course in Canada you really have to be a bit more cautious about future inflation risks. At the moment, we do feel the US fiscal stimulus in Europe as well. to the extent that, for instance, our manufacturing data, the outlook, the order situation looks pretty good. But over here, this sort of comparatively modest boost from the US is offset by the near-term worsening of the pandemic in some countries, Germany and France. So it kind of the news, bigger US stimulus, but extended lockdowns in Germany and France are on balance for the ECB. So again, the ECB can afford to tell us, let's wait till June before we tell you anything about our future plans.
But do you think come June, the market will be ready to hear what the ECB has to say? Do you think that they can pull off tapering without a tantrum as the Bank of Canada did yesterday?
They probably can, and the ECB has it very easy because they do most of their asset purchase through this ultra-flexible PEP program, which they can adjust by the week, the purchases. And they will probably tell us in June that if markets stay calm, they will then return to the pre-March pace of purchases. Remember, in March, they raised the pace of purchases in response to somewhat unsettled bond markets. Now bond markets are calm, and the ECB can probably say in June, okay, if markets stay calm, we buy less in July. But if markets then react negatively, if we were to have a bit of a tantrum, say in bond markets, then the ECB could at any time step up its purchases again. So this flexibility of the ECB's main instrument probably makes it comparatively easy for the ECB to gradually scale back asset purchase in the future if the economy really picks up, and to do so without unsettling markets much.
Holger, you talk about the stabilization in the European bond market that we've seen, but in other European assets, we've seen capitulation, stocks near record highs, the euro back through 120. It seems to all be based around this idea that the growth outlook is improving as the vaccination story improves in Europe. To what extent has it improved? What are your expectations going forward, and how are they different from maybe earlier this year?
Well, weirdly, the expectations are very close to what we had earlier this year, because we have these offsetting factors. The one is that the pandemic has and is still weighing more on the Eurozone economy than we expected early in the year, simply because of this rapid spread of this UK Kent variant of the virus in parts of the Eurozone recently. On the other hand, the economic evidence is that the damage from restrictions early this year, as far as we can tell by the data, has been even less bad than expected. Also, we get a bit more tailwind from the US, from the global situation. So all in all, our forecast for about 4.2% economic growth this year is close to where it was at the beginning of the year. And the experience of the US and what we start to see in the UK suggests that once economies reopen, it will really, really be a fast rebound as consumers just want to spend the money once they can.
Holger, given the latest polls and kind of, now we know exactly who's running for chancellor in Germany, what would a government run by the Greens look like?
A government run by Greens is a question we can't really answer, because there are two options for that. If the Greens have as a partner, among their partners, the small Liberal Party, for instance, then the small Liberal Party would prevent a major shift in economic policy. So we would basically see the Green focus combating climate change more intensively than has been the case. But if the Greens were to run a coalition without any counterweight from the Conservatives or the Liberals in there, if they were to team up and could team up with the hard left party and the Social Democrats for a majority, then we could see a more significant tilt, especially towards more regulation of the labor market, the housing market, a few other sectors of the economy, that would not derail the short-term economic upswing, but it would be a significant dampener to the long-term growth outlook for Germany. This is the tail risk to watch, not whether the Greens are in government, but with whom the Greens would run a coalition if they are in government after the September election.
Holger, thank you so much. Holger Schmieding, their chief economist at Berenberg, joining us on the ECB, but also on German politics. Now, coming up, another blow to Credit Suisse as the bank expects more Archegos fallout in the second quarter. Part of our interview with the chief executive, Thomas Gottstein. That's coming up next, and this is Bloomberg.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Well, it's been a tough year for Credit Suisse, which has been rocked by one scandal after another. And the pain is not likely to end anytime soon. Well, Credit Suisse's first quarter results this morning may have been better than expected, with a net loss of $275 million, but it says an additional loss of $655 million from Archegos won't be seen until the second quarter. The Swiss regulator FINMA has also opened a probe into Credit Suisse over Archegos and Greensill. Now, earlier we spoke to the chief executive, Thomas Gottstein, and asked him whether the bank's problems were now over.
We have addressed most of the issues now. Archegos, we are down to the last 3%. We have exited the positions to a large extent. And we have raised almost $2 billion with a mandatory convertible this morning. We have taken action in our risk organizations. We have taken management changes. So we have done quite a lot. Still some work to do in the second and third quarter, but we have taken a lot of measures.
So why did you arrive to the decision of doing a convertible bond instead of doing something else or just raising capital outright?
Well, we had conditional capital. That's the best way for us to raise the equity. It's a short 6-month maturity. It was important for us to basically get to a 13% CET1 ratio, which on a pro forma basis we now have. And that was important for us to take the capital discussion off the table.
So what concrete measures are you actually taking to reduce risk, especially in the prime brokerage business, beside tightening financing conditions?
We are going through the entire portfolio. We have already started to reduce the risk. Our plan is to reduce leverage exposure by $35 billion by the end of the second quarter in this business. And we will take further action in terms of control systems, both on the first line of defense as well as in the second line of defense.
Before Archegos, you also warned of a possible financial hit from Greensill. What's your best estimate on that?
Greensill, we are working through with the administrator of Greensill Capital. We have brought back $5.4 billion in terms of cash out of the original $10 billion. We have good visibility for a large portion of the remaining positions. There are 3 more distinct positions which we'll work through over the next few months and quarters. We are not planning to do any form of step in. We are very clearly focused on getting the cash back to our investors. That's our priority.
So what is the status overall of the 2 reviews? And because of these 2 incidents, do you see any further personnel changes?
No, we don't foresee any other personnel changes at this point in time, but we obviously are doing an investigation. The board is doing the investigation, and we will inform about that outcome when we are ready to do so.
Are you looking at any risk parameters in other parts of the business outside prime brokerage?
Part of the investigation will also focus on the overall risk organization, the risk processes, the risk systems. We are also in the process under the leadership of the board and myself to look for a new risk officer. As you know, we have appointed Joe Oechslin as our interim chief risk officer, and we will then inform further once we are ready.
But so do you think you'll have to tighten risk parameters and in other parts of the business?
Well, we had two incidents, one in asset management, one in prime services. We have had a very strong record over the last 10, 11 years in terms of credit provisions. If you look at our provision for credit losses, it has been a very strong track record over the last 11 years. So I don't think we have a DNA problem in terms of risk, but we will definitely review all our risk systems and processes as part of this exercise.
So after this exercise, how different do you think Credit Suisse will look?
Look, we have an incoming chairman from the 1st of May. We will, together with him, review our entire organization, and we will then also inform the public as we move into the second and third quarter.
So what will your priorities be when the new chairman starts? What are you looking at?
Well, the priority now is to really go back to running the business and to have, again, a stable situation. That's very important for us, and we are open for business. One of the reasons why we did the mandatory convertible was also to have the strength of the capital base, not only to withstand any possible shock, but also to grow the business. And it's important for us that, especially in Asia, in Switzerland, but also in IWM, we have the capital to further grow the business.
Well, that was the Credit Suisse Chief Executive, Thomas Gottstein. Joining us now is Elisa Martinuzzi, Bloomberg opinion columnist covering finance. And Elisa, I feel like you and I talk about Credit Suisse actually at least on a daily, if not hourly basis. What will happen to the Chief Executive? So he's been in charge for 14 months. Can he survive this?
Well, it's a good question to ask, Francine. I think with the capital raise in particular today, both the CEO and the CFO, both of whom have been with the bank very, very many years, have both tried to get ahead of the news flow to show, they're shoring up the balance sheet. That's safely in hand now. So in the event, and there's no talk of it now, but in the event that there should be more regulatory demands for capital, that is all taken care of. But I think what we are learning, what we are seeing in the increasing disclosures around what happened, is that there's obviously some significant risk failings, risk management failings involved in the situations that you mentioned, the Archegos and Greensill Capital. In Archegos in particular, it seems that, while a lot of banks were doing business with this fund, it seems like no other investment bank was doing so much business with this client, a client that turned out to have, very large positions, very concentrated positions, leading that, very, very large loss. So I think, the company is conducting some probes. The regulators are obviously conducting their own probes. It's early days yet in terms of the potential further fallout that we'll hear about in the next few months.
Thomas Gottstein on the call was talking about how the underlying business looks strong, and yet that doesn't really seem to matter because all of the focus is instead on these crises. When we talk about reputational damage, how long is that going to be the focus for Credit Suisse and the actual fundamentals of their business kind of put to the side?
Well, there are two issues. There's one, the reputational one that you raised, which is a very valid one. So far, so good. The first quarter numbers showed the bank was still attracting new money from clients, which is a good sign. Visibility on the second quarter was a little bit less clear, so it's not evident whether the clients have maintained that confidence. But I think back to your earlier point about the management maintaining that the business is as strong as ever. Well, it is very strong, but it's on the back of taking a significant degree of risk. So the question that remains unanswered is, what's the impact on that business if you're not taking that much risk?
Thank you so much, Elisa Martinuzzi there from Bloomberg Opinion, of course, covering the banks for us and looking closely at Credit Suisse. Now, coming up, we'll continue the conversation on banking with Ralph Schlosstein. He's the Evercore Chief Executive Officer. That's at 12 p.m. in New York, 5 p.m. in London. And this is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance Early Edition. I'm Francine Lackman, London. Kaylee Lyons in New York. Matt Miller off today. Now, Tom Keene, co-anchor of Bloomberg Surveillance, joins us. Tom, we've always talked about Credit Suisse in the past together, especially on earnings. This is much bigger than earnings. This is like, what does this bank become afterwards, and what's the future of the chief executive?
This has been a 20-year train wreck, as you well know, Francine. You know this better than anybody else in financial media. Eliza Martinuzzi and others on the street trying to figure out the share dilution. They have a problem because the simple dilution is 4%, but that's not how you calculate it. And the number we're working with is a 7% share dilution off this convertible note. Let's go to the chart, Francine, quickly here. And you can see the European debacle here in yellow, Deutsche Bank, in white, Credit Suisse, and in red, UBS on a relative basis doing better off the crisis of 2007. These are three struggling banks.
Yeah, they are. And Tom, so I had a conversation with the chief executive, and actually I was just trying to understand what the strategy is. And I have to say there were very little details.
I agree, totally.
You know, first of all, I mean, you know, he came on, which was not easy to try and explain when you don't have a clear strategy or you don't know exactly what kind of risk you have out there. I would suggest that they seem to be pinning a lot on the incoming chairman who starts on May the 1st. And then you wonder whether everything's in the open, whether they get taken out, whether there's a new chairman a new chief executive that the chairman will put in place, or whether they sell off assets. So far, they've denied that.
I just look at the share price and I look at almost the Swiss culture involved here, Francine, and I really don't know where this bank is in a year. I mean, I thought, you know, he was basically numb on your interview.
But you ask yourself, Tom, why, right? So is it the investigations? Is it that they don't know how much risks there's out there?
I'm going to delve into Swiss culture here, and we don't have time for it. I think they're benumbed by the Bondstroff and, you know, the two-bank structure of Zurich. I mean, all it comes down to is UBS and Credit Suisse, and we keep it going, we keep it going, we keep it going. Yeah. What I'm looking at is 7% share dilution to present shareholders.
Right, and that can't continue, so something will happen. So I know you'll look into that very deeply. Thanks so much, Tom Keene, of course, coming up in the next hours. Now, this is what we're watching for the rest of the day. I'm watching the European Central Bank. Kaylee, we're not expecting a huge change, or actually no change in terms of policy, because that will be for June, but it'll be interesting to see also how maybe Christine Lagarde answers to some of these questions about regulation and banks, because this is something that the ECB at the margin also needs to look at.
Yeah, I definitely will be watching that at 7:45 a.m. Eastern time. And before that, I'm going to be taking a look at airline earnings. American and Southwest due before the bell. Not about the first quarter. They're going to have lost money. It is all about the outlook going forward and when they see travel demand picking up. I'm just really hoping, Francine, one of them is going to be able to tell me if I should buy a flight to Ireland or not, Francine.
Yeah, just pick the person that actually says the correct thing. I feel like it's like Cassandra in a crystal ball at the moment. Now, coming up in the next hour, Russ Kostrich, BlackRock Global Allocation Fund Portfolio Manager. This is Bloomberg.
minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
And I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy and we need companies to step up.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Just been hugely stress tested here, right, with this bond yield tantrum, and sort of markets sort of survived.
You're looking not just at the peaks, right? You're looking at the sustainability of these trends.
Where policy stance is today needs to be seen through, but absolutely there are some tough decisions ahead.
What the bond market is telling you right now is not so fast. Fed has the upper hand.
We still have the long-term structural forces that weigh against significant acceleration in growth.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. We were going to start the morning in Frankfurt. We've got to start it in Zurich, Switzerland. Tom Keene, Credit Suisse down another 5-6 percentage points.
A busy day, but I think you're right, John. You go right to the common stock and the analysis of it. I think the coverage has been very weak, to be honest, and that this is about share dilution. When in doubt, nail the present shareholders. Eliza Martinuzzi has a calculation off the street of a 7% share dilution. The reality of that, John, is stunning.
Raising $2 billion and taking another 600 million Swiss hit maybe in this quarter as well, Tom. JP Morgan, the analyst, coming out and saying the following: capital has mainly been addressed. The questions remaining: strategy, risk management.
I don't buy it, John. I just don't buy it.
Have we had the answers to that?
John, I don't buy it. Strategy is out the window. You are taking it. You're taking to the common shareholders, to the cleaners, and they, on an emergent basis, have to adjust this bank and stop the share price decline.
Do you think you've heard enough? Have you had enough clarity, transparency over the last couple of weeks from this bank?
I don't know. This has been going on for years with Credit Suisse. I think, Francine is expert on this with her many interviews with the previous management and the present management. I thought he was basically leaden this morning. And the bottom line is, what does this bank do? They go back 1856. They funded that magnificent rail system of Switzerland, and they become are they the weakest of the bulge bracket banks?
Well, right now, yes, because they're in trouble. Every time there's a problem in Europe, they're at the epicenter of it. Tidjane Thiam, Credit Suisse, is CEO in a former part of his tenure, was talking about de-risking the bank, Lisa. De-risking the bank, and clearly they weren't successful at doing that.
No, and they are saying that they are going to de-risk further, in particular in their prime brokerage account, reducing the amount of leverage that they extend. And I got to say, I wonder how much that's contributing to a little bit of softness in markets as banks around the world consider doing the same. I will say, though, to your question, John, has transparency been enough? a lot of questions about where the losses stemmed from, why Credit Suisse did not exit the positions earlier, and how it could be that they still have some positions still on their books. And the answers were not clear. Credit Suisse's executive management saying that if we had exited earlier, it wouldn't have stemmed the losses that much. How could that be, John? What's the explanation then?
And will Thomas Gottstein actually achieve what Tidjane Thiam tried to? Look, the reporting coming from Sri Natarajan in the last week or so has been amazing here at Bloomberg, Tom. Credit Suisse executives had given the point salesman to Archegos on its swaps desk the new responsibility of instead overseeing risk-taking in the broader prime brokerage unit, according to people with knowledge of the matter. What happened here is still something I don't think we've had a decent explanation on.
And the distinction here, John, is other banks, maybe they made the same decision and it was a wrong decision to back this family fund slash hedge fund slash massively leveraged institution, but they got out of it, and then other banks had the decision not even to participate. And I see zero contrition. I see almost an MBA numbness of consulting as they try to manage their way out of this debacle.
But as you point out, Tom, this goes way before Thomas Gottstein.
I would suggest
this is Tidjane Thiam. I remember going over to Credit Suisse in the early part of the last decade, catching up with Brady Dugan and talking about the strategy then as well. We've been talking about this for a long time. What does this bank look like?
I'm glad you mentioned Mr. Dugan there as well. You know, I'm not going to take it back to their acquisition of Donaldson, Lufkin, Jenrette of years ago, or even the first Boston acquisition of 1978. But this is a bank that's just stumbled forward. And again, you see it this morning with the ultimate answer. They got to build up tier one capital, so they do a 7% share dilution.
Stock's down 6%. Got to do a couple of things this morning, Tom. Credit Suisse, one of them. ECB.
I wore my ECB tie
a little bit later.
It looks good on radio.
Thanks for that.
You like it, John?
Thank you. It looks fantastic.
Madame Lagarde selected this for me long ago and far away.
Brilliant. Lisa, there are two of the things we've got to do. We've got to talk about Earth Day as well. The president set to announce a new target for the United States to achieve a 50 to 52% reduction from 2005 levels in economy-wide net greenhouse gas pollution in 2030. A renewed effort from this administration, from this country, from the federal government, Lisa, on this Earth Day.
Yeah, and a renewed effort also to lead in this front, and that is a key question. How will the U.S. lead on this front following the Trump presidency? Interesting to see also what teeth Biden puts behind some of these assertions. How much money are they going to put behind this? How much money can they put behind this if you don't have bipartisan support for some sort of Green Deal or financing such going forward?
Three big stories for us through this Thursday morning. Let's get to the price action for you. Tom Keene fired up this morning. Equity futures down around about 1/10% on the S&P 500. Yields unchanged at 156 on US 10s. In the FX market, euro dollar 120.46, up around about 1/10%. Just a little bit of euro strength, Lisa, going into the ECB meeting a little bit later this morning.
Yeah, a lot of uncertainty, though. 7:45 a.m. We get that ECB rate decision followed at 8:30 a.m. Eastern time by Christine Lagarde's press conference. The key question will be, after June, what happens? The ECB has been accelerating their bond purchases. Will they continue to do so after June? What are their inflation targets? How much inflation will they tolerate? And what bonds will they be buying? These are all some of the questions that Christine Lagarde will be facing amid a rather, I don't want to say split, but you hear different things from different arms of the ECB body, which perhaps is a bit of a problem. I'm John. I'm sure you'll get to that. 8 a.m., President Biden is going to kick off this two-day climate summit that's being held virtually. We already talked about the idea that the U.S. is going to be aiming to cut their emissions in half by the end of 2030. Key question is, how much momentum can he generate and how much credibility can he engender, given what kind of financing the U.S. can promise behind this? And then at 8:30 a.m., U.S. initial jobless claims. This has been really noisy data. And I wonder at this point whether this is even useful data. And yet we are expecting to see an increase in the number of initial jobless claims this week from an already elevated level, albeit way down from the peak of the pandemic. The key question is, what information can we glean from data that is highly messy and suspect? At the same time, is there a sense of how much services employment is being brought online, how much we are seeing some sort of easing in the strains in employment?
Go on, Tom.
No, I just think it's really important. George Saravelis with a brilliant note this morning, making very clear Canada's different than U.S. Canada's generating jobs, John. We are not. It's not about restaurant jobs. It's getting the labor economy back on track. Saravelis says it's not happening in the U.S.
What's interesting about this statement coming out of the administration, these gas pollution reduction targets, the greenhouse gas pollution reduction targets, Tom, aimed at creating good-paying union jobs, securing U.S. leadership on clean energy technologies. Precisely, that is at the top of the fact sheet released from this administration. Top of the pile. Let's bring in Russ Kostrick, shall we? BlackRock Global Allocation Fund Portfolio Manager. Russ, I want to go straight to this market. Been really choppy over the last month or so. You've been at the epicenter of it together with Rick Reeder, saying we're trimmed up on some of the risk-taking. Are you still maintaining that position?
We are, Jonathan. Good morning. So we are still overweight stocks. We have brought down our risk a bit. And, again, nothing too surprising there. It's been a huge run. We continue to expect very strong economic data. But there are also some other issues. And clearly the market is going to have to navigate this transition from incredible monetary accommodation to thinking about what removing some of that accommodation is ultimately going to look like. And while I don't think we're looking at a full-blown taper tantrum, as we saw back in late February and March, if we see these spikes in bond market volatility, it does have at least a temporary effect on how equities are trading.
I look, Russ, where we are, and everybody's trying to reset right now. We're resetting ourselves into a boom economy. What have you changed in the last 2 weeks in your mindset?
In the last 2 weeks, we haven't changed that much. As I said, we have trimmed a little bit of equity risk out of the portfolio. But if you look at the basic structure, it's more or less the way it's been the last several months. We're still very underweight duration. We expect rates to move higher. It is hard to reconcile negative 70 bips on real 10-year yields with an economy that's likely to grow 7, 8, 9, 10%. Pick your number in the coming quarters. We're still leaning into...
Hello, traders. Are you ready to trade Bitcoin? I'm looking to buy this time Bitcoin. So if you're looking to buy Bitcoin, I'm going to place an order to buy at 53,917. Okay, I'm looking to buy Bitcoin at this price. So if you're up to Bitcoin, please place an order and follow my trade. Stay with me and we will go through this trade together. Okay, stay safe and let's wait. It probably will take a while, but you never know what's happened with Bitcoin these days. Until we will get filled this order. Stay with me and I'll speak to you after when this order will be filled. At this moment on level 2, you can see our order waiting for get filled. Speak to you later. Please restart right now. I will restart my channel streamer. So restart in about a few minutes. Okay? I'll speak to you later.
Said yesterday, and you're dead on, John, the Verone shift here of really getting a little more hesitant is interesting. One of the themes I'm hearing here from the Buy the Dip crew, John, is they're looking at this as your chosen opportunity. When do you have the courage to go into buy?